What you're about to watch is not just an overview of premium financing. It's a full-blown deep dive led by our very own head of product and case design, Alden Armstrong, along with industry expert Kris Stegall from Robin Glen. And let me tell you, they leave no stone unturned. What is premium financing, how it works, how to set it up properly, who's it actually for. They go into real case studies and show the real numbers and inner workings behind this advanced tax strategy. Now, we've also broken the entire masterclass into chapters, so you can pause it easily, come back, and navigate to sections you actually care about. Now, a quick heads up. We had some unexpected tech issues that impacted the audio. It was borderline unlistenable, but shout out to our incredible editing team. They were able to fully recover it and bring it to a place where it's smooth and consumable. Without further ado, enjoy this one-of-one Premium Finance Masterclass.
Today, we have Kris Stegall. Kris is going to be coming from Robin Glen, really focusing in on advanced planning, advanced structures, tax strategies, insurance strategies. And today we have the honor of talking to Kris about something that their firm specializes in, which is premium finance. We'll go into the details, but just a precursor to speak to Kris and his team's expertise. They placed over $1 billion in financed premium on life insurance cases, leaving legacies of multiple billions of dollars for the families that they serve. So Kris, thank you for coming in. I'm really excited to have you.
Thanks so much for having me. I'm really looking forward to having this conversation with you. We're going to have a lot of fun.
Amazing. So Kris, a lot of our viewers ultimately are looking for generational wealth. We've had many opportunities to serve people on life insurance side for the last almost decade, but some people need a more creative solution. And we were asked to make some additional content around premium financing. Now, we're going to address the elephant in the room, which is you, and you do have an extreme expertise in premium financing. I'd love to hear from you for our viewers. What is premium financing? Who's it for? How's it works? Give us the 101 overview.
Yeah, sure. Look, at the end of the day, it's not an overly complex idea. Premium financing at the end of the day is borrowing money from a bank, using that money to pay premiums on a life insurance policy. So those two mechanics, very simple. Everything that happens underneath that, not so simple anymore. So just start there.
Yeah. Okay. So from a simplicity standpoint, is this analogous to, okay, cool, I'm borrowing from a bank to buy a house? Same idea.
Yeah, same concept. People have been using debt for a long time to finance purchases of large things for a very, very long time. You see it in homes, just like you mentioned. People use it to buy cars. People use it to buy buildings. You know, there's all sorts of reasons to use leverage. Smart money knows when to leverage their dollars and use other people's money to buy stuff. Financing life insurance premiums, same thing.
Okay, amazing. The interesting thing about premium finance in our space is feel as though it was talked about a lot about 4 or 5 years ago before rates started coming up. And the only people who are still talking about it actually know what they're talking about. Can you speak to that? Why we heard about it a lot before and now we're hearing about it less now?
Yeah, for sure. And I think it's important to note that premium financing has been around a very long time. So even before the interest rates were zero effectively for a number of years there, it was being done, right? So there's always been this idea of if there is some sort of positive arbitrage between what you can get from a bank from an interest rate perspective and what an insurance policy might credit, and then other things that you're actually using that capital that you save to finance, investing in other things, as long as those mechanics work, then premium financing can work. I think that what you are mentioning though is when interest rates went to that floor, when they were practically zero for a long time, I think it was very, very easy for a lot of insurance professionals to go out and say, look at this incredible arbitrage we can get right now. And they would project that forever, which is unrealistic. But I think that's why you saw and heard a lot of it for a number of years, because it was very easy to illustrate and show. And I think that in today's market, obviously interest rates are higher. And so I think that now you're seeing, those folks that really understand how to use leverage when it applies, and then the real mechanics behind our traditional life insurance policy and interest rates. And again, what you're doing with your outside capital, with the previous you're saving.
Absolutely. And being in the insurance industry, as we both are, we both understand that it's extremely easy to make an insurance policy look very sexy, depending upon how we structure that illustration, right? And what I've unfortunately had the privilege to see is a lot of people sold a bill of goods, such as free insurance. And hey, check this out. You don't have to pay any premiums. The bank takes care of it for you. Can you describe what that quagmire is and why it's such a bad thing?
And it's so much more than that too, because you're right. They'll show very, very high illustrated rates. You usually see that more with an indexed universal life policy. And I'm sure we'll dig into that quite a bit as we continue this conversation. But you also see it honestly when people are illustrating the interest rates as well. So I've seen a lot of instances where somebody will show this nice, shiny life insurance ledger, like what you're talking about, with very, very high returns baked in year over year. And then you have an interest rate environment where they're showing it going consistently down. Right. And so you have this high credit over here, an interest rate where you're projecting it to go down. Nobody knows why you're projecting it. Yeah, right. You're projecting it away. It looks great. It's really good. So yeah, you got this nice little shiny thing. And again, to your point, when people are illustrating it that way, they might say, and look, because we have such substantial arbitrage between these made up things, right? You could maybe capitalize your interest. And what does that mean? That means you're not making an interest payment on the loan. You're just rolling it into the loan. Yeah. And so if those numbers work on that nice, pretty spreadsheet, then somebody will say, well, look, you may not even have to make any premium payments on this. It could be free insurance, but I need you to this is really important right here. Yep. And I want you to say it with me. Premium financing is not free insurance. Somebody is paying for it, period. You're literally borrowing money from a bank and making those premium payments to an insurance company. There's risk all across the board there. You really need to be focused on.
But we're going to dive into more case study examples where your team has actually stepped in and helped people that find themselves 5, 6, 7 years removed from when they started and they bought this idea of free insurance. And now they're having to come out of pocket ridiculous amounts of premium, signing over additional capital in their business for collateral or real estate that they own. At the end of the day, like you said, this is a tool. This is a strategy. So what I'd like to dive into next to kind of round out this particular session is who should be considering premium financing?
Yeah, for sure. Look, I think that there's a couple of things here. One, you've got to need or want life insurance. If you don't need or want life insurance, then just stop immediately. There's no point, right? There's not. Now, if you do have a need and a desire for life insurance, then you need to look at the ways that you could fund it. Now, there's two very common ways. One, you own cash. Great. Or two, you borrow cash. Yeah, let's get the cash, right? So it really becomes a question about what are you doing with your other assets, and does it make sense to finance versus just traditionally funding an insurance policy with just cash, and where we see that scenario playing out for higher net worth people. So first, this is definitely for higher net worth people. I would say that at its base, 5 million net worth minimum, but I get more comfortable with somebody's worth maybe 20 million, 30 million, 40 million, 100 million, billion, whatever. So my baseline is a bit more in the 20 million-ish range. Okay. I just feel like that demographic can weather the storm a little bit easier than somebody who's worth 5 million. I also think that business owners make really good sense for premium financing. So you'll see a lot of business owners, what's the number one thing they want to do? What does a business owner want to do?
Grow their business.
They want to grow their business. And the only way to grow their business is to deploy their capital
back into their business.
But sometimes they need life insurance for
death benefit protection.
Death benefit protection. Yeah. Sometimes they need buy-sell agreements or to fund buy-sell agreements. Sometimes they have estate tax issues that they've got to address, all sorts of things. But with that person plowing all their money right back into their business, they need the life insurance. They need to, they need a flexible way of paying for it. Premium financing can start making a lot of sense.
Because if I'm a business owner and I know my business and my market really, really well, where I know if I put in $100,000 into my market, I'm going to yield a 10x return. Well, cool. I'm probably not going to want to put that into a life insurance policy. I may get a 10x return on a death benefit that I never get to, reap the benefits of, right? It's for my beneficiaries if I sell, whatever that might be. And so I can see how for a business owner, it'd be very, very helpful to figure out a more cost-effective way to purchase insurance that I need for my family or for a buy-sell, as you mentioned, to buy out additional partners if I pass. But at the end of the day, I think what we're really going to dive into in this series is premium financing can be dangerous if it's not done correctly. Working with a proper team, people who have experience, it's the ultimate cheat code when it comes to preserving your wealth because you're using leverage. You're aligning with a firm that does the coordination of all the complexities that we are going to dive into. So unfortunately, what we see a lot of in this industry is premium financing because the premiums are so high on average, $500,000 or more per year. We have what I would consider inexperienced agents pitching premium financing, going out and finding somebody to help them with. After the policy is enforced, there's no support. There's no coverage. There's no ability for that person to continue to help you in your journey in premium financing. These types of plans have to be managed. And if they're not, we're going to dive into some really unfortunate case studies. But fortunately, they were able to connect with people like Kris to fix the gosh awful situation they find themselves in because there was no management. There was sold incorrectly to people who maybe didn't even need to consider premium finance.
Okay. Yeah. And look, premium financing, it's not a trick. Again, at the end of the day, this is a tool. This is a way to fund a life insurance policy. And actually, speaking of funding a life insurance policy, there's something I want to talk to you about on that piece as well, because whenever you finance a policy, you have to sort of structure the policy appropriately to build up as much cash value as possible for the structure to work. You need cash value to build up for collateral purposes, because the first line of collateral gets a loan. It's a loan. It's got to be collateral somewhere. Is a cash surrender value of the insurance policy.
Okay.
And then second, I know we're going to spend some more time talking about this later, but it's also often used as the way to exit the bank loan also. So a lot of times you use the cash value of the insurance policy to pay off the bank loan. But I know, Alden, you and how you do with a lot of families you're working for, you often use cash value build up as fast as you can for other purposes, right? For like retirement income and things like that. And I think that the way the policies are structured for financing is the exact same way that you're structuring it for income. So you want to talk a little bit about how you structure those policies?
Yeah. Well, at the end of the day, we understand that the IRS loves to take money from us, right? They get taxes. That's the whole reason that they're in business. And life insurance is a fantastic place to store capital and never pay tax on those dollars. Again, if it's structured correctly and held in the proper entity or vehicle, right? Within that, because the IRS wants to tax our dollars, we have to do it within their guidelines. So the guideline that they use is the MEC test. The MEC test effectively says you need to be buying a certain amount of death benefit for the amount of premium that you're paying. You don't buy enough death benefit, it crosses into a territory where it becomes a modified endowment contract. That means it changes the entire tax chassis of that policy. All of a sudden, if you want to access dollars, you may be taxed on those. Okay. So where we are with premium financing, we're in a very similar situation where if we want to maximize our cash value, I have to buy as large a death benefit as I need to justify the premium I want to pay. Okay. In that context, what that does for us is gives us a lot of cash value. That cash value, as you know, can be used as collateral. So the bank is looking at the insurance policy as partial collateral for that loan because the cash value is growing every year. Whole life, it's guaranteed to grow up and down. So on whole life, you have a cash value that's guaranteed to increase in value every single year you're alive. The only question is how fast. IUL, a little bit different, right? We have caps, we have floors, there's insurance costs that increase over time. So it can get a little bit more complicated, but the same idea, more cash value in the policy, the better collateral the bank has. Now, we also have to have an outside collateral, right? Because that collateral in the first year, as our clients know, we may be able to get 80% of your premium in cash value. But if you borrowed 100% of your premium from the bank, where's the other 20% that you need for collateral coming from?
Yeah, how's that work? Yeah, it's an excellent question. And I know your viewers really love to dig into the tax code. I've read some of the commentary on some of your videos before, so I know that they like to dig in. So just to kind of roll back a little bit, so the code section that defines what a life insurance contract is in the United States is code section 7702. So for those who feel like going and reading the code, there it is.
Have fun.
And there's two tests. There's a cash value accumulation test and you have the guideline premium test as well. As long as the policy meets those, for as long as it's a contract, then you're good to go. And I think that the way you were describing how you fund the policy is exactly right. Said a little bit differently, what we're actually doing is putting as much premium as we possibly can into the insurance policy and the smallest death benefit relative to that insurance policy. Seems counterintuitive for most people when you think about life insurance. You usually think about putting the smallest amount in there to get the largest amount, but this is sort of the opposite. Now it plays out long term, and we'll talk about that, I'm sure, a little bit later. But again, the point is to build up as much cash value as possible. So if you've got, a large premium going in for a relatively small death benefit, our cost of insurance is based on that net amount of risk, that difference between the death benefit and the cash value. So we're compressing what that cost of insurance actually is year over year and allowing that cash surrender value to build up as fast as possible inside the policy. Right. To reiterate your point just a second ago, you're right. It's used exactly for the purposes you said, collateral, because it's first line of collateral to the bank. And then at some point in the future, we're probably going to use that cash value to pay. Right. Now, outside collateral, it's a fantastic question because everybody's always like, oh, I can go borrow money. I can go put it in here and I don't have to worry about it anymore. Like, well, there's this little side bucket over here called the Gap Collateral. So I've never met a bank who didn't want to be made whole on the risk on something that they're lending. Like they're going to lend you money to go buy a house. They can go take your house if you just like paying on it, right? This is how it works. This is just typical leverage. And it's no different with life insurance. So especially in the early years of a contract when that cash value is going to be lower than that debt, right? It's just the natural order of how life insurance is funded. You're going to put a premium in. Generally, the cash value is going to be lower first year, same very second year. At some point, there'll be a crossover and the cash value will be greater. But in those earlier years, the debt will be larger than the cash surrender value. And so you have to have a Gap Collateral account. So banks are usually going to say, that's great. I need you to post either via control agreement or move assets over to our institution of Gap Collateral to make up the difference.
Cover that difference.
To cover the difference.
Got it.
And an interesting point here, though, is that banks, they love giving out money, but they are, risk averse. It's just funny on their side. When they're lending it out to people, they're risk averse. It's a whole different thing. But when they're giving it to you, they're risk averse. They're like, no, we want to make sure that they were good. So to build in a little additional layer of conservatism on the bank side, they will often do a advance rate on both the cash surrender value and also the collateral account. So when you look at a life insurance policy, they'll say, okay, what is the projected cash surrender value going to be next year on an IUL basis? Probably the guaranteed, which is really zero, right? So what does that look like? What's the worst case scenario for next year for collateral purposes? And for a whole life policy, they'll either look at that guaranteed side of the ledger, if you can get it, or they'll look at the low point letter. So a lot of whole life carriers will provide a low point letter because, as you know, costs of insurance come out monthly, dividends are credited at the end of the years. There's a little bit of lag there. So a lot of times they'll ask for a low point letter. So that's the bank saying, I want the worst case scenario, and I'm probably just going to give you 95% against that value. Okay. That's your first line of collateral. That's the cash surrender value. That's how they look at it. Then you have the Gap Collateral side. So if you have a bucket of marketable securities, to say it's relatively liquid, it's highly diversified, you can go, that's awesome. I love that. We'll give you 70% advance rate on that. So you can do the math really quick and say, you're going to have to post a little bit more than something minus something.
Got it. And I think that kind of brings us back around to the salient point that we've touched on a couple of different times, right? Because you're not just buying an insurance policy in this example. You're going to partnership with a bank. That bank is going to be made whole, whether you like it or not. And so if you don't have a plan and a system to mitigate the ups and downs in the market, however that policy is performing and funding over time, and then interest rates changing over time, if you don't have the ability to pivot with all of those changes, you can find yourself in a lot of trouble in the future. So at the end of the day, I think it's very important to understand it's not a trick. It's a tool. It's something that we have to do right the first time and manage long-term through the relationship. So I think at the end of the day, what we're saying over and over again in this video is if you're going to be moving forward with any financial arrangement with a bank to fund your insurance policy, make sure you understand what it is, how it works, and ultimately how your team that's helping you set up this entire process is going to support you long-term.
Yeah, no, that's right. You really do have to have a team, and it's not just your insurance advisor. There's a lot of other people that go into that. A good way to wrap this segment up, I think we covered quite a bit, at least at a service level, right? We've talked about the who it might be good for and the why they might want to use it. We touched a little bit on the importance of the team around you in order to actually facilitate a successful premium finance and transaction. And that shouldn't be thought of just in a vacuum for today. I mean, this is a life insurance policy, 40, 50 years, and buckle up, right? We talked a little bit about exit strategies and how to think about getting out of the bank loan. We only referenced using cash value, but there's other things to consider there too. And then is it for you? Maybe, maybe not. It's a risk assessment. And then, again, going back to the idea of partnering, knowing who your bank and your lender is as well. We touched on that just a little bit, but the bank plays an extremely important role in premium finance. Imagine they're the ones that are handing out the dollars. And then I think we touched a little bit on how this kind of should fit into broader estate planning, but we'll go deep on that here pretty soon.
So diving into the details here, I think what we're going to get very clear on in this episode is who is this for, what makes somebody a good candidate, and why that person should maybe consider premium financing.
Yeah, for sure. And again, just to reiterate your point, I'll start by saying this. Premium financing is not for everyone.
Yeah.
It's simply not. At the end of the day, it's for folks who want and need life insurance and also have better ways to deploy their capital where leverage makes sense to acquire the insurance policy. Don't buy premium finance life insurance because it looks good on a spreadsheet and because somebody showed you this thing that will never fail or whatever it is that they're trying to pitch you. Again, let's go back to its baseline. If you don't want life insurance, don't buy premium finance life insurance. It's silly. If you do want life insurance and you have a good reason to deploy your capital back into your businesses, to go buy real estate, whatever you want to do, set up your funds because you're going to earn 15, 20% somewhere else. That's the kind of individual that the financing is good for.
So as a blanket statement, would you say it's fair to say if you're an individual who feels as though putting money into life insurance will detract you from being successful elsewhere, premium finance may be a better option if you need and want insurance?
Sure. Yeah, exactly. Right. So if you can maximize your use of capital using leverage to acquire the insurance that you want and need, then absolutely. That's where it starts making sense.
Perfect.
100%.
Perfect. Talk me through, let's go into some details now.
Yeah.
Who is that actually? What have you seen? What have you experienced?
For sure. So first, you still got to have some level of liquidity out there. You can't come with $0 in the bank and no securities account and you're 100%, bought up into some real estate property, expect to get premium financing. You have to have that ability to post that Gap Collateral that we talked about. So you have to have some liquidity in order to do premium financing. It just makes sense. Again, banks aren't going to lend to somebody who's got no balance sheet, right? So for a few groups of folks that premium finance life insurance, at least in my experience, has worked really well for. When we touched on this particular demographic in the first episode, business owners, right?
Yeah.
So I think I asked you in the first segment, what do business owners like to do the most?
That's their business.
Grow their business. That's right. They want to deploy all their capital back into it because they know their market. They know where they're going to make significant returns. They're seeing things on the horizon they want to invest in, and they need to deploy their capital that direction. Business owners also need life insurance, right, Alden? What do they need life insurance for?
Well, a couple different things. From one pure protection standpoint, maybe it's just death benefit protection for their family.
Yeah.
Also, if they have business partners, you got a business worth, $10 million. They own 50% of that. If you pass away, all of a sudden that business has to come up with half of the business worth to pay out their heirs. Better way to do that might be life insurance. So there's two examples that I think are really good for business owners is, does your business need death benefit for some reason? Buy, sell, could be executive benefits, any of those types of things. And the other side is personal. And that's where we play bread and butter, life insurance, death benefit protection to protect the families that we care about.
Yeah, you nailed it. That's exactly right. From a buy sell perspective, if you have a business that's got two partners and something unfortunate happens to one of them, without this partner, to your point, how are they going to come up with the capital, the liquidity, the cash to buy out the surviving spouse or the heirs? Because you may not want that spouse to be suddenly a 50% partner in your business, right? Maybe you do. I've seen it work both ways, but the likelihood is you want to have that funded buy-sell arrangement to prevent things like that happening. It makes the family happy because they're going to get cash. They're getting equitable value for their company. And then, the surviving owner is getting control over the company, which is what they're probably going to want as well. From a cash flow perspective, again, financing could make a lot of sense here. We said business owners want to deploy all their capital back into their business. So if you want to try to minimize that for at least for an extended period of time, financing could make a lot of sense in that scenario. I think for those that, I see this a lot with families that own a business. It's just like a single family enterprise. Estate taxes can become a significant issue for them. So if you have a closely held business and it's worth, hundreds of millions of dollars and the matriarch and the patriarch pass away and all of a sudden Uncle Sam says, hey, I want 40% of that. That's mine. Well, I don't think the heirs are going to sell that business to pay off.
At least the hope is they don't have to.
Right. Because we don't have
seen that, which is not actually
we have. And so if you have that life insurance policy that the family owns, then now they have that liquidity.
You have an option
to go pay the estate tax.
Perfect.
They have that option. That's right.
Yeah.
So business owners are classic, great demographic for premium financing. Another one, while you have to work on the liquidity a little bit.
Yeah.
Real estate investors.
Yes.
I mean, what is the number one thing that real estate investors want to do?
More money into real estate.
More real estate. It's like a dog chasing a ball. That's it. It was only real estate. The unique thing about real estate investors, though, I do have to appreciate is that what do they often use to buy the real estate? They get leverage. Yeah. Right? So they really understand how to maximize their dollar into real estate. And so for those individuals, those families, premium financing can make a lot of sense because they already understand the leverage. They get it. They just have to start understanding the insurance policy. I think another interesting aspect that I see a lot with real estate owners is that sometimes, well, let me ask you, what's the other thing that real estate owners really like to do with their properties?
Rent them.
Well, they also like money off of them. They also like to depreciate them.
Yeah,
right?
Appreciate that. Yeah.
Because that saves their income taxes or, so they depreciate them. And so if you depreciate that and you sell it, well, you're paying cap gains or whatever it is on that entire value, right? And so what we see a lot of families do is they might hold on to that real estate until they actually pass away
to get a step up for their
to get a step up in basis.
Right.
But if you keep those assets inside of your estate, they're subject to estate taxes. So if you don't want your children or your heirs or whoever to have to sell some of those properties or some of those buildings to pay that 40% tax because you want that step up in basis, life insurance starts making a whole lot of sense to cover that.
Yeah, it's the same thing we talked about for the business owner, is providing the liquidity in the time that's needed to give you the options to do what you need to, right? And it's funny when we're working with real estate investors, so many of them, we're looking at cash out refinances, pull as much equity back out of those properties every couple of years as we can.
Yeah.
So I'm curious, from a financeable perspective, if you've got a portfolio of X number of properties and they're all basically leveraged to the hilt, does that provide any capital for the bank to collateralize that loan? Is still very, very important. And I think a salient tagline for premium finance will be, if you can afford to buy insurance, you can probably afford to borrow to buy insurance. But it does not work the other way around. If you don't have the liquidity to purchase the insurance policy you're looking at and you're relying on somebody else to do that for you, that's a recipe for a lot of bad things to happen down the road. Would you agree with that?
Gosh, you are absolutely correct. If you can't afford the premium on a life insurance policy at its base, premium policy is not for you. Just stop right there.
That makes your agent extremely happy for that first year.
Yeah.
And you can see him like, he's in Barbados. He's not going to get it. There's definitely some concerns there. So what I think would be really helpful now is to kind of walk through a dollars and cents example. So let's say we have $1 million of premium at 5%.
Sure.
That's what we're borrowing from the bank, right? And that's going to buy us $30 million death benefit.
Sure.
Making up numbers here.
Yeah.
Right. So in this example, walk me through, what does that business owner, in this case, have to pay for that insurance policy? We know $1 million's being paid.
Yeah.
But what do they have to pay?
No, you're exactly right. Yeah. $1 million is being paid. Again, this is not free insurance. Somebody's paying the premium. Bank's giving you money. You're giving it to the insurance company, right? But your point, there's an interest rate associated with that loan. Just like any loan, there's going to be that interest rate. At 5%, that means year one, there's going to be a $50,000 interest accrual that's due. Year one could be 50 grand.
So that individual would have to come out of pocket 50 grand. And that's, regardless of any collateral on the table, that's would have to be paid.
Correct. Yeah. Unless, for some reason they decide to capitalize the interest, they would have to come out of pocket 50 grand.
And that's where we get into the brief thing we talked about last time, which was free insurance. And this idea of, hey, 50 grand is due, but don't worry, just lump it in with all the other things that you owe us. And that's maybe not a road we want to go down right now, but that's how that would work.
Well, I think it's okay. And we can touch on it a little bit because to your point, if you capitalize interest, that just means you're going to pay interest on top of your interest. So over time, that is just going to balloon, right? It's effectively a balloon note at that point if you're doing it that way. And that's on top of the fact that, and I think that you're about to say this next, well, year two, it's a life insurance policy. So you're probably going to fund it for at least 5 to 7 years, maybe 10, depending on the design.
So another premium of $1 million out of the bank's pocket.
That's right. The bank.
You still have an interest rate.
Correct.
But now you have an interest rate on that year's premium and the last year's premium.
Correct.
Yeah. And so if you're paying that interest every year, the first year you paid 50.
Yep.
Second year you pay 100. That's third year 150. But now imagine that same scenario where you're capitalizing that interest.
Sure.
All of a sudden, now you're paying interest on your interest on your interest. Compound interest is amazing. And it's been deemed so in that first year, we have the interest of $50,000. They're paying that out of pocket. The next year, now they owe $50,000 for the first year and the second year. So $100,000.
That's right.
Third year, you can see where the trend goes, right? $150,000. If they're capitalizing that interest, we can get into some concerning territories. Right? Compound interest is an amazing feature if it works in your favor. But if it doesn't, you can get into some trouble. And that's the whole concept of free insurance, right?
Yeah, I guess the concept of free insurance is you capitalize interest forever and eventually it gets paid off somehow.
So that's somehow.
Which again, and I don't want to say that, capitalizing interest is an awful thing to do. Sometimes it can make strategic sense, right? So again, if you're that business owner, you're in year 5 of the structure and you're like, I've got to go buy a dump truck. Like, okay. Go buy your dump truck. We understand what that means. You're going to capitalize here, but we'll probably get to, you got to understand what that means for the long term.
Yeah. It affects everything.
Risk of this, right? Because that's what it is. You're just, it's just adding additional risk into it by not managing the loan.
Well, we can see that from a dollars and cents perspective, if I could choose to pay $1 million to a life insurance company out of my pocket versus 50 to a bank, 50 to the bank may be very, very attractive for all the reasons we've mentioned before. And, no one wants to die early, but if you did, that $30 million death benefit in this hypothetical situation would still get paid to the beneficiary, even if you only paid the bank one time.
No, that's right. Yeah. Any life insurance policy, by design, when somebody passes away, the death benefit pays out. Now, the bank is going to be paid first to pay off the loan, and then whatever's left is going to go to the kids via trust or outright or however that's set up. I know we'll spend some time talking about that kind of stuff later as well. I mean, you hit on a good point there that I think we need to reiterate as well. So let's say it's a $1 million premium, as you said. But let's just say, for example, that the annual premium on if you just traditionally funded the insurance policy was, I don't know, $500,000. Just making numbers up, as you said. Well, the advantage of using financing is that now you have that 500 minus 50, that $450,000 to deploy elsewhere. That's the real power of of finance life insurance.
Right. So said another way, in that $1 million of premium, let's say the required minimum premium for the death benefit you're buying, right, is $500,000.
Sure.
The rest of it is being used to, well, let's say, overfund that policy, get more cash value in there, increase the cash value collateral in the policy. But what the point that you just made was, because that extra premium is building up additional collateral, if you have only a premium obligation of $50,000, you can put the rest of that money, right, that you would have otherwise been paid just for the cost of insurance, to use elsewhere.
Yeah, that's exactly right. No, you hit 2 points right there. One, you're maximizing the cash value buildup just by nature of the way that the policy is structured and the way you're funding it. And then two, you get to redeploy the capital that you're saving in what a traditional premium might be, less the interest that you paid. It's a big deal.
Perfect. Well, Kris, walk us through what you've seen in the real world. And we're touching high level examples of, hey, they work for this guy, they work for this guy. Who has it worked for? And maybe walk us through some examples that you've seen.
Yeah. And I think I kind of, we scratched the surface a little bit on who it kind of worked for. Like, again, that's the demographic that I'm very comfortable in. So I've got families, like there's like a couple of brothers, single family office, that's their enterprise. They didn't need it for buy-sell agreements. They had done a tremendous amount of estate planning at their level. What they needed it for was for additional liquidity for the next generation. So, oftentimes we think about death benefit to help cover estate taxes or help with buy-sell arrangements like we were just talking about. But sometimes you can use life insurance, one, for those purposes, but then also to create a pool of liquidity for the next generation to use. So it's almost like a way to ensure that the wealth is perpetuated multiple generations. So sometimes it's just another way of looking at it. Yeah. So as an example, I've got a single family office that I work very closely with. So single family office, it's already set up to be multiple generations, and just about the way it's designed in both their corporate structure and then also in their trust structures and everything else that they've got going. They've done a lot of planning to help minimize what that potential estate tax liability is going to be. So for them, life insurance was one part, helped true up the sort of the gap that still existed on the estate tax side that you just couldn't plan away. But the second sort of aspect of the death benefit was to really create liquidity for the next generation to continue to deploy, and even the third and fourth generation. So almost like a cycle of ensuring that there's a lot of liquidity and that wealth is perpetuated for multiple generations. So it's just another way of looking how to utilize a death benefit beyond just estate taxes or buy-sell arrangements. That particular family was looking at it from a liquidity perspective for future generations. Cash is king. You never know what's going to happen.
Gotcha. So their need was still, they wanted that liquidity, but it wasn't for estate taxes or for buy-sell. It was like, this is probably just a more efficient way to leave a legacy because of the way this insurance could be funded.
Yep, that's right. So if you think about like what a family needs, especially if they're thinking that long, they need to fund things like education for their children. Maybe they want to inspire their kids to do, create their own businesses, like entrepreneurial mindset. That cash gives you the ability to do those. That's perfect. That's right. It's like it almost allows the family office to become that family bank because it always has that liquidity.
Got it. Perfect.
Again, I've seen this a lot in real estate. I've got quite a few real estate moguls essentially that understand that they don't want their prize buildings to be sold to pay the IRS. Like I don't know a single real estate investor that's like, I can't wait to pay the IRS.
And let's pause there for a minute just to clarify. What are we saying when we mean to pay their IRS after they pass? We're talking about estate taxes, right? Sure. And I think something that a lot of people don't fully understand is that, mom and dad die, all of a sudden we've got an estate tax bill to pay for. No worries. They're worth $100 million. But is it liquid?
Right.
And what we often see is that while the dollar figures may look good on a balance sheet, all of a sudden those dollars shrink by 30, 40, 50% if you have to sell it in a 9-month period.
Oh no, that's a really, really good point, because if for some reason, and there's two problems there. If for some reason, one, real estate markets are down and they have to
in
sell
that particular year,
well, you just sold in a down year, nobody's going to enjoy that. And to your point, if you have to sell something within 9 months because the estate taxes are due, after 9 months of passing, well, that could be a fire sale, because maybe there's not a lot of buyers out there interested in said properties, or maybe it's hard for them to come up with the cash to.
Well, closing on massive commercial properties can take 4 to 6 months.
Yeah.
Or longer. It just depends. So having that liquidity from insurance,
it's huge.
Yeah, can fix that problem for sure.
It's huge. And then, this is a bit more of the human side of things, but the idea of having to leave it to a trustee or your heirs to decide what to sell, that is not, they should be grieving, not worried about funding the IRS.
Funding the IRS. I like that terminology. That's really good. That's what we're all here for. I don't know if you knew that or not, but yeah. So what else can we dive into?
Well, let's see. I think another interesting demographic that I've seen this work really well for is celebrities, believe it or not. So, those that are in the entertainment industry, athletes, they're just coming off of some substantial contracts, especially in the athlete world. They come off of these big contracts and maybe they're starting to retire and they're trying to figure out what to do. Yeah. A lot of those athletes are looking for different things to invest into and deploy their capital to become the next, say, Magic Johnson as an example.
Oh, yeah.
Right. The
very successful businessmen that started because they had a lot of cash flow.
Yeah, exactly. You're John Elway, right? There's a lot of them out there. But they figured out how to successfully deploy their capital into things like real estate and hedge funds and alternatives and whatever else, but they need that life insurance all the same. So yeah, I see a lot of that demographic looking for financing as well, so they can maximize the deployment of their capital efficiently.
Amazing. Well, in this segment, we're really talking about who a good candidate is. I'd like to briefly touch on what are some bad candidates that you've seen pitch this idea that you've come in and say, hey, why are we even talking about this nonsense?
Yeah.
What have you seen?
Yeah. And I think it's almost sad to have to say it, but you pointed out, they're pitched it. Yeah. Right? So they're pitched like, this is, shiny investment object A, and it will never go wrong. And this is what it looks like on the spreadsheet, and this is what you should expect. So we see a lot of, more fortunate enough to get to see them, because a lot of people do come to us for second opinions, or to review, you pointed out, we're doing something that I've already done, or to deploy something new. But what I see a lot of times is that if we're lucky, we catch them, before they actually acquire it. Yeah, we'll see people who are like dentists or doctors who have been pitched financed retirement plans. So it's like, don't go into your 401ks or your Roths or your IRAs. Just do premium finance life insurance as a way to supplement your retirement income. And to me, that doesn't make any sense, because one, the doctors didn't say they had a need for life insurance, period. Right? They want a retirement plan.
Yeah.
And then two, their cash flows can be a little tricky at times. I see a couple of things out there. I think that a lot of times somebody will come to me when we're fortunate enough to catch them before they've actually acquired the premium finance life insurance. So that's the spreadsheet that they were sent, the prospectus, whatever you want to call it. And sometimes, not all the time, they'll send us a life insurance ledger as well. Sometimes we have to go back and try to reconstruct
that from the agent.
Which is fine. We can do that. And so they're often pitched this rosy picture of like, this is how this thing is going to work. And when, after just a couple of questions, to be honest, because like, if there's anything you'll learn about me, it's that I'm not very good at saying, oh, you want that? Sure, I'll give it to you. I'm going to ask questions because I want to know that it makes sense and fits your broader plan. Like, what are you actually trying to accomplish? And if they can't tell me what they were actually trying to accomplish, if what they were trying to accomplish is what somebody told them they should do,
it's a red flag.
That's a red flag. Yeah, it's not a good fit. And if they didn't understand that, if it's an index universal life policy, what it means to be in a 1 year point to point with a cap and a floor, and maybe the cap can change. Yeah. If you're in a volatility controlled index, well, what does that actually mean? If volatility is high and you're in a lot of cash, all of a sudden, what does that mean for what that policy projections might look like? A lot of people don't understand either that when we touched on this earlier, when you exit the bank financing, and if you're using the cash value from the insurance policy to do that, there's oftentimes a loan component to that. So you're really taking a loan from an insurance company to pay off the bank.
But now you just basically refinanced.
Right. You just refinance with with the insurance company, which again, which is great. I mean, that's
better loan structure.
It's a great way to exit the bank financing, but it's still a loan. And so a lot of people don't necessarily understand that, like the major mechanics behind that. So where my red flags my spidey sense starts tingling a little bit is when I ask a few questions like, well, what do you mean? I don't understand.
I'm buying life insurance?
Yeah. I'm buying life insurance. Yeah. This is guaranteed.
No,
it's not. It's not guaranteed.
It's effectively what you're saying is oftentimes this can be pitched as a shiny object. Hey, you said you were interested in some retirement solutions. Check out this premium finance opportunity. Sure. Look how shiny and nice this is on this piece of paper. And what I've unfortunately seen, like, at Better Wealth, because we have a fairly large brand, we get people sending in like, hey, I got pitched this. What is it? The ones that scare me are people who send in like, hey, check out this thing that I just got pitched. I'm currently in underwriting, or hey, I just got approved for this policy. Should I move forward? And to your point, start asking questions. They don't understand what they're buying. I don't understand how advisors can ethically get people to the point where they're ready to pull the trigger on this massive decision. And that person has no idea how it works. Yeah. They don't understand the implications. And that's scary. That's very scary.
No, it is. I think we said it before. Premium financing is perfect for those who don't think insurance is complicated enough. Right. I'm going to go back to that quote because I think it just makes sense. I think that the other piece, and you're hitting on this as well, like sometimes people will try to make these programmatic, right? So it's now a program. So they've got their insurance company that they're working through, and they've got an institution that they're probably trying to get all the bank financing done through. So another thing that often asks is, who's the bank? And if there's silence, then you know that, well, I don't know. Why?
So who are you getting to bed with? Do you know?
And they made these assumptions about what the interest rate is going to be. Well, where was that born from? How did they come up with that? Are they using a SOFR curve, or are they choosing like, oh no, historically the difference between the interest rates and the crediting rate is 2%. So we're just going to take the hypothetical crediting rate, subtract 2, and that'll be our long-term interest rate because that's what we expect. I'm like, how does that make any sense? You might have a crediting rate at 7.5 at one insurance company, at 6 at another. Are you going to use 5.5? Or are you going to use 4% as your interest rate? Like it doesn't make any sense, right? And so people can't answer those questions. That tells me that whoever was, pitching them didn't really explain everything.
Yeah, probably my favorite, actually one of my first times ever being exposed to premium financing a couple of years back was a physician who came to us, wanted to do just some multi-generational insurance planning for his adult children and his grandkids. Worked together, kind of got that all figured out. About halfway through the process, because we weren't doing insurance on him, we had deeper conversations around what does the state taxes look like? And he's like, oh, I've already solved that problem. Amazing. What do you have? What do you have enforced? Diving down this road, he had premium financed a very large insurance policy portfolio. And I think we actually may go into his case study later on. And in his particular situation, the bank lending rate that was negotiated was like 4 or 5 full points above the average interest rate at the time. So he was massively overpaying on interest. And for what he was trying to accomplish, it didn't actually get him any closer to his goals.
Well, that's unfortunate. And you said a word negotiate, and I think you meant didn't negotiate. I'm a firm believer in advocacy for clients, and underwriting as much insurance as y'all do, just as we like. Underwriting health it's an art, right? You have to get that correct, and you got to know what you're doing. And the second part is underwriting the financing, and you can't just go to one institution. Like I kind of take this RFP approach. Like I'm always going to work on behalf of the clients, and it doesn't just stop year one. You can't, again, this is a living, breathing thing. You have year one. Well, a lot of times those loans are just 1 year revolvers. So like year two, you got to go back and make sure that nothing changed. Or if it did, well, why? Do I need to refinance? There's all kinds of different things we can go down. But I think, again, they just didn't negotiate.
Yeah. Their advisor was also MIA for like a decade.
Shocker.
So we've kind of covered a lot in this particular episode, talking about, real profiles we've looked at or ideal candidates for this type of insurance strategy. Any additional thoughts you want to share on the avatar, let's say, for the type of person that could be looking at this?
Yeah. Again, I think just going back to the beginning, I mean, if you have a need, a desire, a want for life insurance, and you have a healthy appreciation for leverage because you can deploy your capital in other meaningful ways, then you might be a good candidate for premium financing. If you don't want life insurance, don't.
Amazing.
It's not gonna overcomplicate that. Don't buy premium finance life insurance if you don't want life insurance.
Perfect.
We're going to really talk about who premium financing can work for and why, right? I think it's important to note that financing is not for dabblers. You got to know what you're getting into, and have a commitment to it. And you'll see that through sort of the case studies and folks we're gonna chat about. And it is also not for people who can't afford to buy insurance. You need to be able to afford the insurance, the coverage that you need. For some of these folks, it makes more sense to leverage it because they can deploy their capital elsewhere. And so if you fit those two molds, need life insurance, can deploy capital elsewhere, then you'll see through what we're about to walk through how financing can make sense.
So, Kris, you and I have had a conversation now for what seems to be a couple of hours where we're talking through this idea of premium financing.
Yeah.
And something that I think is going to be very helpful for people watching this is just getting clarity on mechanics. How does it actually work? Why is this leverage thing that we're talking about so valuable? And so we're going to be showing some illustrations. Now, this, if I'm understanding correctly, this is not an illustration you presented, but it's really just giving us a broad strokes idea of what somebody could be presented from an insurance company. Is that fair?
Sure, that's right. I think this is a representative of something you might see out there in the wild.
Yeah, out there in the wild insurance world.
Yeah.
Amazing. So we're going to walk through an example of putting in $1 million a year for a 10-year period, borrowing those premiums from a bank, and we are going to be paying interest to the bank every year. So our outlay as a client in this example is only going to be in the interest.
Right.
Now, the policy cash value is also going to be collateralized, and there's going to be some additional outside collateral that's going to be required. Is that right?
Yeah, no, you're exactly right. So at the end of the day, you have to find a way to illustrate this somehow. And so this is a really good example of what you might see out there in the wild if somebody is pitching premium finance or somebody's giving you a premium finance presentation. You might see something along these lines. And it really does. I mean, these things do a great job of outlining what the mechanics are. What they don't necessarily do is show the mechanics of what can change over time. They might allude to it, but it's not really illustrating what those potential positives and what the potential negatives are of leveraging it. A lot of times what you'll see in the first sign is what the illustrated premiums are on. And that's coming directly from the life insurance illustration itself. It's how the plan was set up. We talked about max funding it relative to the death benefit.
Right.
This premium is the maximum amount of premium you can put in for, in this example, a death benefit of almost $14 million. So $1 million goes in. The estimated interest due, simple math, is going to be the loan amount, which in year one is just going to be that first life insurance premium, that $1 million, times whatever that prevailing interest rate plus your bank spread is for that particular year. So in this example, it's showing 5.54%. So typically, whenever I'm looking at these, I'm trying to look at the SOFR forward curve as at least a baseline for the conversation, and then adding, say, in this example, 125-point spread above that because the banks also want to make money.
Gotcha. So said another way, the interest rate that's being used here is the interest rate that the bank is giving us, right? That's what we're having to pay, but they're borrowing, at a different rate, and that's from the SOFR forward curve.
Yeah. So the SOFR forward curve is basically what the Fed is saying they expect interest rates to be over time. So this illustrates what the Fed thinks the interest is, what they're at least trending towards or trying to trend towards.
Gotcha.
A bank will take that value and then add the spread. Yeah. So in this example, the bank might be using SOFR, so the secured overnight financing rate, which is basically what banks how the rate they can borrow from each other. But they're going to take that and they're going to add a spread onto it because that's how they actually make money. There's a cost of money for banks to lend, so they add a spread to it. So in this example,
Gotcha.
using that SOFR forward curve plus a bank spread of say 125 basis points.
Got it. And that's the number we're seeing here in the estimated loan rate.
Exactly.
SOFR plus the bank spread.
Yep. Until you get to year 10, because the forward curve only goes out for 10 years. So it levels itself out at 5.25 because you have to plug in something, right? So these are all assumptions. I think that's important. These are all just assumptions, and they're all things you have to be able to talk through because you have to understand, again, we're just talking about the estimated loan rate here. You have to believe that loan rate is going to work in your favor for the long term. Right.
Yeah.
So if you're sensitive to interest rates going up and it gives you heartburn, maybe financing isn't the best plan for you. But if you can weather the storm and you understand that those values are going to ebb and flow depending on things like unemployment, things like inflation, all the things that drive what the Fed does to help figure out what that forward curve is going to look like, then that's okay. If you feel like you can weather that storm and or believe that your whole life policy or your index universal life policy, which are the two types of contracts that are used for financing, are going to maintain some sort of an arbitrage against that, and you're comfortable with that, then it can work. But that's essentially where the estimated loan rate comes from. Yeah.
Amazing. So we're effectively saying that in any illustration, there are assumptions on top of assumptions
Sure.
that make it look right. I mean, that's just insurance in general.
Of course.
So as we're walking through this left to right on the loan details section, we've got illustrated premiums, $1 million a year, estimated loan rate using the SOFR forward curve, including the bank spread. And then where that next column is the amount of interest that is estimated to be due in that year.
Yep.
What you'll notice is between the estimated interest due and the estimated outlay, those numbers are identical. So earlier we talked about the idea of taking interest and capitalizing it every year. That's not what we're doing here. In this example, we're taking money out of client's pocket and paying the bank interest.
That's right.
The bank continues to fund premium. And what you'll notice is the outlay is basically increasing by increments of about $50,000 per year because the loan rate's about 5%.
Yeah.
So conceptually, that makes sense. So Kris, if you would walk us through now the plan economics and kind of see all the moving pieces that are in the insurance policy itself.
Yeah, for sure. So we talked about the premium, right? So that's the first thing that you normally see on a life insurance illustration. Typically, what you'll see next to that is going to be the cash surrender value of the life insurance policy as well. So that's where you see illustrated net surrender value. That's the cash value column in the life insurance policy. I mean, you'll see that grows over time, just as we would expect, because the concept behind this is to put as much premium in there relative to the death benefit, make that cash value grow as fast as possible. You'll see how the cash value grows pretty darn fast. And in fact, by year 7, you see that's kind of the crossover point based on these hypothetical projections, where the cash surrender value is in excess of the loan amount. And it continues to go from there. So that's just the illustrated net value. It's based on whatever crediting assumptions are underneath the life insurance policy itself. So if it's an index universal life policy, the growth of that cash value is going to be based on, whatever index
performance
plugged into. So just some rules that are set on what they're, the max illustrated rate that they're allowed to do. But that's generally what you'll see there. And on the whole life, of course, it's going to be a dividend rate.
Got it. So when we're looking at this chart, the illustrated net surrender value is based on the assumption of some rate of return anticipated within the policy internally year over year. To your point, a index universal life policy plays within certain bounds. You may have a year where you can't lose, quote unquote, because you have a 0% floor.
Sure.
But then on the high side, you're also capped. You may have an 8 to 12.5% cap depending upon the product.
Sure.
So as that index moves up and down, you're capturing only within that window.
That's right.
So the illustrated assumption here is likely around 7%. Is that accurate?
Yeah, that sounds about right.
Okay.
Yep.
Now on the whole life side, to your point, it's really going to be the guaranteed interest on that contract. But because we're looking at, most of the time, mutual insurance companies, we're also looking at a non-guaranteed dividend coming in. That's driving the internal rate of return of the contract.
That's right.
So which type of product are we looking at here?
In this case, is an index universal life policy. And it's a great point that you're making because, again, when we think about all the assumptions that go into how those crediting rates are going to perform over time, nobody actually knows, right? To your point, with a typical S&P 500 index point to point, usually it's got the 0% floor, maybe a 1% with some insurance carriers, as you pointed out. And then there's a cap, and that cap is just for today. Maybe it's 8, maybe it's 10, maybe it's 12, maybe it's 12.5%. But it's important to note that that's just for today. Those caps
can move.
Yeah. It could go up, it could go down. And that's driven by markets and how expensive the options are, basically, that the insurance carriers are acquiring to build that cap and floor. But those things are going to fluctuate over time as well. So the idea of saying on its onset, yep, I got a 0% floor and a 12.5% cap, and that's what it's going to be for the,
life
the
of
entire of the policy. It's not
really.
It's not the case.
Yeah.
So you also have to be willing to weather that storm as well. As if the caps fall, well, what does that actually mean for the insurance policy and the likelihood of success of my premium finance portfolio? If it goes up, then that's great. Or another index that's common in index universal life is sort of an uncapped volatility controlled index as well. So instead of taking an S&P 500 with a 0 floor and some cap, you might have a low vol index with no cap. And that might sound great until you realize that, low vol just means that
the volatility,
it's low volatility. So your returns are likely going to be lower than what you'd see in an S&P 500 bucket. Right. In which case somebody comes out and says, but the low vol ones have a very high participation rate. It might be 150% of what that index does from, year over year. And that's great, except that also that participation rate can go up
up
or down. So there's
Right.
levers on both. So again, it's not a bad thing. It's a feature of the product. It could go either way, but you've got to be willing to accept that there is that transfer of that risk depending on the budgets of the insurance companies at that time.
And would you say that most of the premium finance cases that are written in our current economic timepiece are illustrated for index universal life?
Yeah, I would say that most of them are. I think that, when you look at a sheet like this, if you can illustrate, 6 or 7% into perpetuity against say a 5%
whole life product
interest rate. Well, no interest rate, then you've always got that positive arbitrage that's built in there, right? That said, I do see a lot more whole life coming into the picture over the last, I don't know, say 5 or 10 years. And I think the reason is because there is that understanding that things can change in an index universal life policy. And with a whole life policy, yes, the dividends can change. It tends to be slower over time though, right? And it seems to go along with the interest rate environment at a lag, right? So, I mean, this is a general statement, but that's kind of what people see over time. And so if you really take the position of like, I think that I want something that's guaranteed. I want something that's going to be there. I don't want to think too much about participation rates and caps and whatever
all
else is
the
happening,
variables that may
stuff.
change on me.
And again, going back to the whole idea of why you're using the premium financing, it's not necessarily because of always just the arbitrage between the insurance policy and the interest rate, although that's important. The other side is where you're deploying your other capital. And if you don't want to have a whole bunch of stress, then maybe the whole life approach makes more sense. If you're one of those, it's like, nope, I love the markets. I think everything's going to go well. I'm not worried about, the ups and downs. And I understand that. And I'm more interested in hitting like a bigger home run, then IUL might be the right choice for you. That's right.
So as we kind of walk through the additional columns here, what I think we're going to get into in a couple of minutes is what can go wrong. You started to allude to a couple of things there.
Yeah, a little bit. Yeah.
But as we look at just the plan economics, the column directly to the right, right over here under estimated collateral. Yeah. So we've talked around this idea of collateral for a while. We understand we're borrowing money from a bank.
That's right.
That bank is going to be made whole whether you like it or not. So when you're going into a relationship with a bank, let's talk about what collateral can even be used for this particular column and how that plays out.
Yeah, for sure. So again, the first line of collateral for a premium finance transaction with a bank is going to be the cash surrender value of the insurance policy itself.
Yep.
But a bank,
which in this policy illustration initially is about $280,000.
Correct. But remember,
end of year value.
That's end of year value.
Crediting rate. Yeah.
After we've assumed that something is credited. So what banks are really going to look at is not what that hypothetical is going to look like if you get, a 6% dividend or 7% IUL return. They're going to look at it from the worst case scenario possible because they're looking at it year over year, just like we should be managing this thing, right? So on a whole life side, they're either going to look at the guaranteed side of the ledger. So assuming there's no dividend, or they're going to ask for a low point letter. So again, what is the worst case scenario for the entire year that cash value could be if something goes wrong? So on the whole life side, that's what they're looking at. Generally, they'll give you, say, a 95% advance rate, maybe 100% advance rate on that guaranteed worst case scenario cash surrender value.
So the first part of the collateral in the policy up to around 95%. And the assumption is we're going to be looking at the lowest
worst case
section, worst case scenario.
That's right.
So that accounts for, in this example, 25% of the collateral needed. What about the rest? Yeah,
so the rest has to come from an outside spot. You have to have a Gap Collateral account. Usually what I see is cash, which they'll give you 100% on. Maybe it's, CDs or a line of credit or something like that.
Brokerage accounts.
That's what I typically see.
Okay.
Because most people, especially if you're looking at financing, they still want to see their money at work. That's the whole point of going into this. So why would I have a bunch of cash sitting in a collateral account? Usually what I'll see is a group of marketable securities. Usually they're well diversified, and banks like those. They'll give you maybe 65 to 70% of the value, the market value of that for collateral purposes. But it works really well because, again, banks like that, they can work on managing it and the money's still at work, which again is why you went into this financing contract to begin with.
Got it. Perfectly. So in this example, we've got estimated collateral at 65%. So possibly in this example, looking at a brokerage account, they're giving you 65% of the value. And then the next column over, we're looking at the illustrated net death benefit. Now that fun little word there, net, right? Yeah. So this is assuming that if you were to pass in any given year here, that the death benefit being paid out is net of what the bank is contractually owed. All right. So as we walk into the next column here, we have illustrated net death benefit and then benefit net of the loan.
Yeah.
So the difference between these two columns would be the insurance company is showing the death benefit in the policy. And then we also have to take into consideration if you passed in that year, the bank has to be made whole.
That's absolutely right. Like, at the end of the day, and you made this point earlier, the bank is going to get their money back. And so if while the financing transaction is still open and somebody passes away, the death benefit is going to be used first to pay the bank the loan amount,
What they're owed, right?
And then the rest goes towards the family and everything we're
Beneficiary.
trying to do. That's right.
Got it. And so what we'll notice here is as we walk down in the policy illustrations, after 10 years, we're no longer funding into this policy. So premiums are paid for 10 years at $1 million. That's the assumption that we're making. Death benefit every year is growing up to that point. And then explain to our audience, what's the drop off there?
Yeah.
What's happening?
It's a fantastic question. And Alden, I know you have a lot of experience in this for sure. So again, the idea behind what we're trying to do here is build up as much cash value as we possibly can in order to use that as one point collateral, second part, as potentially an exit strategy from the bank loan, using the cash surrender value itself to go pay the bank back. You'll see the reduction of death benefit right there, dropping from 25 to 18 and a half. The reason you do that is you're compressing what the cost of insurance are, right? So if cost of insurance are based on the death benefit minus your cash surrender value, and you reduce that death benefit, you've compressed that delta. And now your cost of insurance are lower, which allows your cash value to grow faster. That's the whole point.
So said another way, what we're doing here in year 10 is we could just be decreasing the amount of insurance being purchased, which is making the overall policy performance more efficient. That's decrease the cost.
For this purpose. That's right.
Got it.
Yep.
And we have an illustrated going out 15 years, and we're looking at all of a sudden, we're taking $10 million out of this policy. So we're going to see an immediate drop in the illustrated cash value of basically $10 million. Where is that going?
Yeah. So in this instance, I think it's a loan from the insurance policy. So you're actually taking a loan from the insurance company, and then you're taking those dollars, or the trust is, or whoever owns the policy, and they're paying the bank back. So that is money coming out of the policy one way or another, and then paying off the bank. So now the bank is out of the picture, and now you just have a loan with the insurance company.
So would it be fair to say that at this point, you've done your relationship for 15 years with the bank? In a perfect world, this is what it's going to look like.
Yep.
And then in that 15th year, you would loan out of the insurance company and effectively refinance the debt.
Yeah.
Right. Because now the bank's paid off, but now you have a line of credit out and open against the insurance policy from the insurance company.
That's right.
Long term, do most people plan to pay that back at all? Or is it just an outstanding balance against the policy?
Yeah. And most of them don't pay that back. It is just an outstanding loan against the insurance policy itself. So whenever, and this is a good point, because this is where that illustrated net death benefit comes from. Whenever you're looking at it on the insurance ledger itself, it is what the gross death benefit is minus the policy loan itself, gives you the illustrated net death benefit.
Perfect. You went exactly where I wanted you to. So our illustrated net death benefit before we took out that loan to pay off the bank was around 21 million.
Yep.
After we take out that loan, it's now dropped to closer to 9 million.
That's right.
And because of that relationship, we have a loan interest rate associated, whether it's a whole life or whether it's index universal life. That loan operates like a loan. The insurance company is making money there.
Sure.
And so that credit in this example is being rolled into the policy. It's being capitalized.
That's right.
Because you'll notice, going back over to this other side, we have $0 due in the estimated interest. So the loan is being capitalized within the insurance policy. I just want to make that clear for everybody watching here.
Yeah. And I think it's also important to note, again, because we just said we're just taking a loan from the insurance company. There's multiple ways to do that as well. You don't have to take a loan. You could take a withdrawal of basis, right? So there's two ways to get money, cash out of an insurance policy: withdrawal of basis, non-taxable event, and then a loan, also currently a non-taxable event. So this is one of those things where, when you're looking at doing an exit strategy, you have to really take that into consideration. Is it better to do a withdrawal, or is it better to take a loan? And then in the insurance world, because we like to really complicate things, do you want to take a fixed loan, or do you want to do an index loan if you're talking about a index universal life policy? So do you want something that's more fixed and predictable? Or again, do you like the idea of, no, I really like the markets and I think it's going to go well forever, and I'm good with, my cash staying in the index side of the equation, even though maybe the loan interest at the insurance company is higher for that bucket.
Right.
Those are just things you have to weigh out.
Yeah. And that's a hard pitch.
Yeah.
Because what I've seen quite a few times is we have individuals who are approached by other advisors that are pitched this idea of premium finance, and they may be already in the underwriting or application process. And like we were alluding to in our last conversation, they may not understand any of the variables we just mentioned.
Sure.
right? What are the options? How does the product actually work? And oh, by the way, this is life insurance, right? And so what I'd like to kind of talk about now is maybe stepping away from the illustration on your screen, but looking at what can change. What are the variables? Can we define those and walk through them together?
Yeah, I think so. So I think that the bank interest rate can change. I think we know that one for sure, right? It's going to be based on SOFR. It's going to be based on prime minus something. That base is going to change over time. So that is absolutely a variable. The second thing is that, there's always a risk of bank spreads going up or down. So, you could have it either way. That's why it's important to stay on top of those things. But if the cost of money gets higher for banks, they may charge a
you
larger
more.
spread. Things you have to watch out for. But that's why, again, working with a group that knows what they're doing,
Manage
that's a moment to
relationship.
refinance maybe to somewhere else that can offer better terms.
So increasing cost of money on both parties, whether it's from where the bank is borrowing money or the bank lending you money, there's costs and associated with both of those.
That's right.
Okay. What else?
So then you have, we can talk about crediting assumptions on the insurance policy itself.
How is it actually performing year to year? That could be exactly like this. Probably not.
It won't.
Or it could be something completely different because the market didn't behave the way you told it to when you sold the illustration.
That's absolutely right. So on an index universal life policy, maybe you're coming out and you get a 0, out of the gate, or maybe you hit the cap. You don't know that, but it's definitely not going to be the same number every single year forever. It's just unrealistic, right? So so those adjustments that fluctuation is going to happen. And then again, with index universal life, you still have that cap that could in theory change up or down. So that's another variable that's built in there. And then if you're using a low vol, your participation rate could go up or down. So that's another lever that's in there.
So define participation rate for our audience real quick.
Sure. So a participation rate would be, it's like a multiplier on the performance of that index from point A to point B. So let's say hypothetically you have, just to keep it simple, you earn 10%. From point A to point B, that index earns 10%. If you have a 200% participation rate, then the policy is going to credit 20%.
20%.
Yeah. That's
gotcha.
it.
Okay. So within index universal life, there's a lot of things that can change.
Sure.
Cap rates can go up and down. Floors can't. That's built into the contract. And then we've got participation rates that also can change, and all that interact with market performance.
For sure.
So it's not a very straightforward product. It is complicated, right?
Correct.
Whole life insurance, on the other side, can be more simple and easier to understand in some cases, because the growth, it is guaranteed that there's above 0 growth in those insurance policies. The dividend is the wild card.
That's
right. And these large mutuals, especially the ones that we would want to use for this type of strategy, like they've been paying dividends for 100, 170 years. And so that dividend, it's a good assumption, but the number is going to change year to year. And that's another variable we would have to account for.
Yeah. You're absolutely right. I think that historically, folks would say that there's a lag between what the dividend does relative to interest rates. And I think we've seen that fairly recently, actually, where dividends kind of stayed low for a while, and maybe they're creeping back up a little bit. But yeah, you have to build that in there. So it's going to move slower. Kind of think about like being the turtle in the race, if you will. It's slow and steady, and hopefully gets you from this point to your exit. The other thing that I think is worth pointing out, and this applies to both index universal life and whole life policies, is that when you do exit, and if a loan is part of that exit strategy, meaning you're taking a loan from the policy, whether it's a whole life or an index universal life policy, those loan rates can also change down the road. So you might be 30 years into this, and then all of a sudden the loan rates go up, or maybe they go down and your performance is better. These are things you have. This is weathering the storm. This is just understanding exactly what you're into and working with a group that's helping you manage all of those variables every year for a really long time.
So I see this kind of breaking out into 4 categories so far. We've got the bank interest rate that the bank is borrowing from. We've got the bank rate that you're paying them, so the spread. We have policy performance, which encompasses all different products, how they work, but really just how much your policy is growing by each year. That's a variable. And then as you exit, you're also looking at, if you're taking a loan, the variability of your future interest on that particular loan.
That's right.
So right there are 4 big assumptions that are being made that are all put nice and pretty into this very nice chart that we're looking at here.
That's right.
Is there anything else that could go wrong? Any other variables accounting for?
There's always stuff, but I would also like to talk about the good things about some of these things too, right? So again, we're talking about, unpredictability of markets, unpredictability of interest rates and all these things. I think that over time, I think it's fair to say that there has been a decent amount of arbitrage between the two. Doesn't mean that past performance is going to guarantee future results, but on its face, it seems like it should work.
Yeah.
The other thing that I think is really important to understand here is that this kind of a structure builds a lot of flexibility for a family to manage their death benefit and their cash flow, right? That's the whole point of why we're doing financing anyway. So we talked about, the estimated outlays, right? So in the early years, that should be much lower than if you were just buying an insurance policy outright. So you're deploying capital somewhere else. That's a great thing. You're making money somewhere else, right? And you're still getting the death benefit that you need. If you have years where it makes more sense to deploy more capital that direction, you want to capitalize interest, well,
You got that
this
option.
actually gives you the chassis to do that. You have to work with the bank to make sure that, it works within the facility. Again, you got to have somebody managing that kind of stuff, but that possibility is absolutely there. So you can help manage your cash flows from year to year. The other thing is you can pay more into this. So let's say you're a business owner and you sold your business and you had a huge liquidity event. Well, if you think about what this structure is doing, if you, in this example, got $100 million for selling your business and you took 10 million of it and just paid off the bank loan, do you know how big this death benefit would be in 40 years if you delevered it without using the policy itself? Hundreds of millions of dollars of death benefit suddenly.
Yeah.
So it's a huge benefit that you can't get with traditional insurance where you're paying your premium, you know what your death benefit is going to be. In this case, you actually have levers yourself that you can pull to help make sure that policy is meeting the long-term objectives of you and your family.
I think what you just shared is fantastic. When you first look at premium financing, when you really start looking under the hood, it's intimidating, it's complicated, and there's a lot of reasons to run away.
Sure.
Right? But if you can get past the understanding of, yes, there's variability, yes, there's volatility, let's say, in the plan, the benefits of doing a strategy like this can be many. That's numerous on the options you have on the table. And I think where the intersection between the intimidation versus the potential of what might be, the intersection of that is a qualified team to help manage the entire system.
Yeah, no, you're absolutely right. If you can appreciate, and we sort of demystified some of the complexity here, I think, to an extent, probably pointed some things out that other people didn't realize. But if you can appreciate the complexity and understand leverage and have a good sense for what the insurance policies are and how they work and the risks and the pros and cons of that, then it can absolutely work really, really well for those families that it works for.
Absolutely. And to kind of put that in perspective, we go out on this illustration, right? Making all the assumptions that we make by building this type of illustration. We go out to, let's say, life expectancy, age 85. We've got a benefit net of the loan. So the entire premium finance situation was taken care of. The bank got paid back. We now refinance that debt into the insurance policy. And net of that growing loan, the death benefit, if someone were to pass at age 85, was basically $33 million.
That's right.
Now, to put that into perspective, Kris, I want to jump over into these percentage charts over here.
Oh, sure.
So if we're looking at an example of somebody with their total outlay, in this example is about $4.9 million.
Yeah.
If they were to put that same $4.9 million inside an investment that they own personally, it would have to generate every single year about 11.5% until they passed. So if we go out here to a hypothetical life expectancy, so let's just say it's 85 years old. So we've got the net death benefit. The loan is already being accounted for here. So the loan to the insurance company. We've got about $33 million worth of death benefit.
Yeah.
Now, I want to try to paint the picture and putting this into perspective. The total amount of money in this example we've contributed to this structure is about $4.9 million. Is that accurate?
Yep.
So that $4.9 million is what we put into it. And so we're going to run over with a couple of percentages that I want to highlight. This percentage right here, about 6.77, what this is saying is if you were to put $4.9 million to work, it would have to grow at an equivalent about 6.77% after tax over a 37-year period to then leave a death benefit behind to your family.
Yeah,
right?
that's right. So your after tax, your net after tax effect would have to be over 6.77% for that to work. So if you have a turnover and maybe your tax rate's 30% per year, that number grows really fast. You'd have to hit a pretty high hurdle.
Exactly. And if we own this policy for some reason in your personal estate, if we compare it to a personal estate asset, you'd have to earn an equivalent 11.3% every year for 37 years to leave the same amount of benefit to your heirs.
Yeah, exactly. That's why it's so important to work with a team of planners around this, because the premium financing in and of itself, we just talked about the bank and the insurance policy. We haven't talked about who owns the policy.
Where is it?
This is why it's wildly important to work with planners who can help you understand that this is important, why it needs to be owned inside of a trust, keep it outside of your taxable estate so that like all that death benefit is free of estate tax and can be used to pay estate taxes down the road.
Amazing.
So one of the things that I think is important to mention, and again, this goes back to the flexibility of this structure. If you look in the later years, you see that cash surrender value is still very, very high.
Yeah.
And the death benefits are only a little bit more than that, right? There still has to be a difference between the two. Otherwise, it wouldn't be a life insurance product. So, but there is a difference there. So if you got down the road and you needed cash for some reason, in theory, you could actually use it for that purpose in that moment as well. So again, that idea of future flexibility and what you're going to use that liquidity for, it could be for that substantial death benefit and leave it alone. But if you come to some sort of a crunch and you need it for some reason, or one of the children want to start a business or something, this could be a source of capital for that kind of stuff too.
Absolutely. So your death benefit is something that's going to benefit your heirs, but your cash value, what you're saying, is also something that the owner of the contract has access to for whatever reason.
Right.
Now, those two numbers go closer together. So to your point, you increase your options along with the policies in force.
Yeah, 100%. So again, yes, there's complexity in financing and there's a lot of levers. There's also a ton of flexibility and potential benefit. And if you can weigh those two and financing makes sense, could be the way to go. Yeah. So again, there's a lot of, levers that can be pulled at the banks and at the insurance companies. And there's a lot of flexibility that the owner can use as well to make those benefits better for whatever they need, immediate cash flow or maybe it's long-term planning. But I think that when I think about premium financing, I kind of think about it as like dating. If you're going to date somebody, you go in, it looks amazing. It's nothing but rosy pictures. You got big googly eyes. You love each other so much. And then over time you realize, well, wait a minute, do I understand everything that I'm getting into? Do I really know this person? Is this something that I want to commit to for the rest of my life? That's what premium finance life insurance is. So make sure that you're dating first before you commit.
Yeah, you heard it here first. So if you're going to start dating, you need a credit score, you need to run that Social Security, you need to have a background check.
Right.
So jokes aside, complicated structures, lots of benefit, but do your diligence in the front end.
100%. That's right.
So we're going to be going through a case study. This case study is going to be an example of why it's so important to work with the right team. Got Kris here with me again. We're going to dive into some specific details here, and we're going to hopefully see how Kris, his team stepping in, gives a lot of benefit to the client in this situation.
I think it's important to preface this with sometimes when you're looking at premium financing, it's not about getting a new premium financing. It's not about new insurance and a new loan and trying to figure it out. Sometimes it's taking a look at what's already been done and seeing if there's anything that needs to be tweaked or changed. So in this particular example, we had a family come to us. They were actually looking for additional insurance. They were looking for ways to save cash as a retirement plan, in addition to this premium finance insurance portfolio that they just sort of said off in the background, like, oh yeah, we have this, but we're looking for more insurance to do this. I'm like, oh, okay, well, we can help with this. But can we also take a look at the premium finance life insurance portfolio? Sometimes we see things in there that people maybe haven't been paying attention to. So they were kind enough to send it over. And it turns out the insurance policies were performing great. Awesome. They got with a company that had kept their caps very high. It was an index universal life portfolio. There were a lot of policies. I think there were 10 of them in total. Lots and lots of death benefit. And the policies were performing fine. Their caps had remained high. All the future projections look good. There's really no reason to even look at adjusting them. They had already reduced the death benefit like we would normally suggest. So that side had been dealt with very, very well. Unfortunately, there's two sides of the equation. There's the lending side, right?
You got the loan picture.
Yeah.
And then you've also got the policy picture. So what you're saying is the policies, they're doing what they're supposed to. They're performing well, good companies, but the loan was concerning.
The loan was concerning. Yeah. Okay. So when they went into it, I think that they just signed the papers and they didn't read it, or they didn't ask questions about, is this the only way to do it? Only loan? Is this the only way to do it? I'm not sure what the history was there, because when you present, oh, I think this is a little bit off, that's the last thing you want to tell you is that, oh, maybe we messed up. But we'll catch that for now. In this particular instance, they had gotten a loan and it was 200 basis points over SOFR. And it was a $30 million loan. So I'm looking at this and I'm thinking, this individual, they've got a decent amount of liquidity. They've got a lot of securities. So yeah, that's a positive. And they've got a pretty substantial loan. That's also positive. There's no more premiums due. So,
that's a positive.
Yeah, that's fine. We didn't have to worry about trying to bake in any additional premiums. But again, 200 over SOFR and really high for that kind of a scenario.
And to kind of recap to the audience what SOFR is. So banks borrow money to then lend you money, right? So the SOFR curve, the forward projection is what we're talking about here. And they're borrowing money at the projected rate moving forward. And then they're adding additional fees. We call that the spread. The spread is what you're paying them, and that's what really makes their profits, right? They make profit off of the spread.
Yeah.
And so in this example, if they're borrowing at 3%, lending 200 basis points over that 3%, then they're up at 5%.
Right. The loan rate that the client in this instance was paying was 5. Now, it was much higher than that because interest rates are much higher
right now.
But yeah, that's the concept exactly. Okay. And so again, when we assessed the risk internally, our team looked at it and said, I think the spread is too high. I think we can get this down.
Better. Yeah.
And with our banking contacts, we don't work with a single bank. We work with lots of banks. And through that network, we were able to get the client down to 125 over SOFR. So it's a 75 basis points saving. I think year one equated to almost $250,000 of immediate savings.
Wow.
And so that's a great net positive going forward because it's not just $250,000 year one, right? That's every year until they exit their saving that amount. So it's millions, literally millions of dollars that they're going to be saving. Now, the disappointing part is that had we, they come to us earlier, we could have caught this earlier, we could have saved them a lot more. But in this scenario, you can't go back and fix history. All you can do is fix what's going forward. So we're fortunate enough to be in a position to help them refinance that. And then, one other thing is just, when you're looking at the terms of the note, sometimes that's important as well. So we only talked about really the interest rate on this one and the savings there. But for this particular instance, the lending institution had a commitment of like 30 or 40,000 that they were requiring for the privilege of working with their institution.
Oh, wow.
Which also seemed pretty excessive to me. So we helped make that go away in the new loan as well. And that's just, again, to reiterate, you got to know what's, just like we were talking about all the levers that can happen inside of an insurance policy. There's a lot of levers in a loan too. And the term, what is your base? Is it SOFR? Is it prime? So one other really interesting aspect of this case was the fact that there was a commitment fee as well built into the loan, meaning for the privilege of doing business with the bank, they were going to charge them like $25,000 or $30,000
banking privilege fee.
The banking privilege fee. I'm like, well, that doesn't seem right either. So we helped negotiate that as well. But I think that points to a broader issue of like you have to look at the loan terms also. Understanding what the term is. Is it a 1-year deal? Is it a 3-year deal? Is it a 5-year deal? Is your base rate, is it based on SOFR or is it based on prime? Does it have a commitment fee? Do you have to pay legal fees? Does it require personal guarantee? There's a lot that goes into it. And again, understanding the mechanics of how that loan is going to work is also going to make sure that, you have good conversations year in, year out about your premium finance portfolio.
Absolutely. Well, it's interesting. If we walk back through just the highlights of this particular case as it was presented to us, right? We've got their already established policies. No more premium is due.
Yep.
The current loan size on the policy right now is about $30 million.
It's $30 million. Yep.
$30 million. They're capitalizing interest. So the interest that's being owed, it's not coming out of pocket. It's just rolling forward. So that $30 million is increasing every year.
That was their structure. Yep.
Right. So that was their current structure. And the policies were performing well, IULs, competitive rates with good carriers. And the current loan terms it was forward curve off of SOFR plus 200 basis points. And then on top of that, there was a $25,000 finance commitment fee charged to the bank. So this is all the information we gathered. And remember, we weren't looking at premium finance for this client. We're looking at additional insurance policies for other reasons. But reviewed this, looked at it, said, I think we could do better. You go and find a solution, and a team will pull this up on the screen for you right now. But in the first year savings alone was almost $250,000.
Yeah.
Because of the loan size over a 10-year period, we're looking at almost $3 million of savings just in interest.
Yeah. And in particular, if you think about it in this case, again, this was a case that came to us, right? They were capitalizing interest, as you pointed out. So that first year savings is say $250,000 because that's capitalizing is only going to get bigger. Right? So you're right. It's like, it's serious money. this there. And this also, because they're capitalizing interest and their exit strategy was using the cash value of the insurance policy to exit it, by reducing that amount of capitalization, it gives the insurance policy a better shot at actually being able to do that for that purpose.
And don't have to come out of pocket with additional collateral premium in the future.
Yeah, exactly.
Right. So I think it's a brilliant, fantastic opportunity to really serve this client and his family well and identify an issue that he didn't even see initially.
Didn't even know. That's right.
Right. And so if you're in a similar situation where you already have premium finance, you feel like it's going well, we're going to be the first people to tell you like, high five, this is fantastic. If it's set up right.
That's right.
And if you don't have any concerns that you may not, may just be missing. And so in the link below this video, we could have a link where you can send us in your existing policy. You can meet with Kris or a member of our team to look at what you're currently doing, what has been done for you perhaps. And we can just make sure that there's no disconnect on what you expect versus what's actually in force. We'd be glad to do that review for you guys. We're going to be looking into a second case study where we're diving into an existing insurance portfolio to see what can be done to make it better or more efficient long-term. So Kris, let's go ahead and walk us through the fact pattern of this case.
Yeah, this one was an interesting one. So again, there's two pieces of the financing puzzle. You have the insurance policy or policies, and then you have the bank loans, right? In this particular case study, the loans that they were using, the spreads on top of SOFR, in this case, it was a SOFR-based loan, were great. It was really solid.
Okay.
Nothing to change there. Great relation. The client had a great relationship with the bank. It was actually a bank that I knew, so that made that nice and easy too. So that was great. Unfortunately, one of the insurance policies, this was a there were multiple insurance policies in this portfolio. One of the policies, remember we talked about Index Universal Life and they have caps, right? So a lot of them have a floor of say 0 and then a cap of, 10, 11, 12 or whatever. When this policy was initially sold, that cap was 14.5%.
Oh,
which
wow.
is awesome.
Yeah.
Right. So if you think about like a long-term projection with a 14.5% cap, it's going to look awesome. Right. Well, the thing was, it actually performed really well as the caps were coming down. So it started at 14.5 and then, every couple of years, it just marched down. So over that time period, the policy had performed well based up to that cap, but fast forward till present day and the cap was suddenly 6.5%.
So snap.
Yeah,
that changes things.
Yeah. So so even though the policy had done really well and was projected to do sort of okay based on how it had historically done, like that future cast of at a 6.5% cap was not painting a very rosy picture anymore. So in that instance, we had to work hard with the family to actually do a 1035 exchange into a newer policy with a much higher cap and a carrier that had a history of keeping caps higher. That's right.
Yeah. And we've gone over in other videos the importance of picking the right carrier, the right product, and trying to focus on carriers that have consistently kept cap rates as where they're issued at.
Yep.
Right. And so with this particular case and this particular client, what was the benefit between the old policy versus the new policy and the way it was structured?
Yeah, so for sure. So again, because it was a 1035 exchange, there was no taxable event. That's just moving from one policy to another insurance policy. So in the IRS's view, that's perfectly fine. You're just swapping products, which is great. What this did though was give it a much better chance of succeeding because instead of being stuck with a policy that had a 6.5% cap, you refinance it and not refinance it, but do that 1035 exchange and you get into something, say maybe now has a 10% cap. Well, that's a 350 basis point swing. And if you take that over a really long period of time, it matters. It's very meaningful.
Yeah.
So the hypothetical projections, it was much more plausible that the portfolio would succeed.
Gotcha. And I see we have some projections we can throw up on the screen right now.
Sure.
So out at age 85, and by the way, do we know how old the client was?
Yeah, she's in her
60s.
60s. Yep.
Okay. So over 20, 25 years, cash value projections are almost $3 million, about $2.3 million difference in cash values over that 20-year period. Death benefit projections were over $2 million, $2.3 million of difference as well.
Yeah.
So again, we've talked about some of the videos. Projections are based on assumptions, are based on yada, yada, yada. But at the end of the day, the structure and potential for upside is where these products are really shine. So we have to understand and control the downside, but we also have to give possibility to the upside. And that's really what you were able to do with this particular policy.
Yep. That's a fantastic point. And I think that pointing out the cash value is even more important because now if we're going to use that insurance policy as the exit strategy for the bank loan, which is what
what the plan was
here.
Yeah.
If you don't have enough cash value or you're very limited in that cash value when you do make that exit, you might put that policy at risk of lapsing, which would really cause some problems.
Yeah. So when what you're saying is if you were to pull, let's say out of that $4.7 million cash value, if you pulled, making up numbers, $4 million for an exit,
yeah,
huge loan now in the insurance policy, small net remainder cash value, your growth on the net remainder cash value versus the growth on that loan in the policy may not be good enough to outcompete the increasing interest.
Yeah. And the additional cost of insurance that are going to be there as you get older.
Yeah. Yeah. So phenomenal outcome for this particular client as well. So this is another opportunity. You've got existing insurance in force. If your company has changed cap rates on you, there are some companies in the industry that unfortunately have developed that reputation for changing cap rates. Even as soon as 2 years after a policy is issued, cap rates come down. And so finding that right company, having a conversation with our team, you want to take a look at that, hit the link below, submit your information, and we'll have a great conversation about what might be possible for you. We're going to walk through another case study. This one's going to be specifically talking about premium financing and why it became the ideal solution for this particular client. So Kris is going to walk us through this case, give us the details, and ultimately show us the solution that was proposed.
Yeah, for sure. This was a fun one. This was the classic scenario where premium financing made a ton of sense. So we had 4 business partners running a very, very successful business. They were anticipating selling their company in about 10 years. So they're expecting this huge liquidity event down the road. And they wanted life insurance for 2 purposes. One, to help fund a buy-sell arrangement if something happened to them internally before they were able to sell. And then 2, because their businesses were doing that well, they also needed some protection against estate taxes. So we worked with them on layering in their insurance policies along with a buy-sell arrangement and some trust to help facilitate both. For them, again, because they were a growing business and they were plowing everything back into their company, they really, like any dollar was going right back into it because they were expecting some serious multiples on their company. But again, knowing they needed a life insurance, they wanted to minimize the expense of that while getting a very substantial amount of insurance. Premium financing made a ton of sense for them.
So before they came to the table, had they already identified the need for insurance? That wasn't something you had to educate them on?
No, they knew they needed it. That's exactly right. So their attorney had discussed with them the possibility of needing the buy-sell arrangement and how to fund it. Life insurance oftentimes makes sense to do that. And the same attorney also pointed out the estate tax implications that they were going to be facing. While there was a lot of other estate planning going on, we could always dive into some other time. They realized that life insurance was going to be a very important aspect of their plan.
And you were brought in as kind of the subject matter expert with Win and Life Insurance.
Yeah, exactly. Okay. So fortunately I come from a background good enough to know like how all the planning is interconnected. So when it comes to how we view insurance, it's often seen as the gaps. When you can do all the other planning you can possibly do, life insurance comes in and it fills the gaps on what you can't do with planning. And this was that classic scenario.
So in this scenario, walk us through what solution was really positioned by your team for this client and what's the benefit that they're going to get from this kind of planning? Yeah,
for sure. So we always try to show at least 3 ways to fund insurance, right? And at least 3, sometimes there's more, but we do. And it kind of falls on the spectrum. So on one side of the equation, we might show like, look, if you go out and you get a guaranteed universal life policy, the premium you're going to pay, the death benefit you're going to get, you're really transferring all the risk to the insurance carrier. This is option A. Option B is going to be something a little bit more in between. This insurance policy, again, traditionally funded, pay your premium, you should get your death benefit, some risk passed on to the client because there's maybe some market risk. Maybe it's an IUL where they need some performance to make sure it goes for longevity, or maybe it's a whole life policy and you're relying on something like paid up ads to get you that death benefit long term. So something kind of in the middle. And then on this side of the spectrum, you have premium finance life insurance where we're trying to minimize the outlay to get the insurance because we're going to pay interest instead of the premium payments we might see on these other policies, right? And still get that large death benefit they need down the road with a lot of other flexibility. So if they need to have a higher death benefit, they can pay down the loan with outside funds. In this case, that was part of the plan because they knew they were going to have that liquidity event down the road. So that ability to say, well, maybe I won't use the cash value to exit the bank loan. Maybe I'll use some actual liquidity and help push that death benefit long term. Something these other policies can't do. That flexibility is what really tended them towards the premium finance solution. So again, we always start with at least 3. For them, this one made a whole lot of sense because of where they were at in the life cycle of their business, where they expected to be pretty soon. where they wanted the cash flow to go, and that flexibility that they love about premium financing.
Amazing. So if you're looking at this over the course of the next 15, 20, 30 years, you're building in this insurance policy, bringing in a bank, funding the insurance policy. If we're going to project out your cash value, death benefit at age 90, what's the difference between money put in by the client, money put in by the bank, and the ultimate death benefit that's garnered by age 90?
Yeah, it's a great example of that. So yeah, if you're looking at the screen, so in this example is a $1 million premium. There are four partners, so this is times 4. So there was $1 million in premiums for each one of them, expected to be paid out for 10 years. So that'd be $10 million going into each insurance policy. The projected interest expense, we were assuming a SOFR forward curve plus 150. We probably could get them a little bit less than that, but I tend to be a little conservative with how we project things. So that was expected to be about maybe 5.2 million of interest expense before exiting the insurance structure. After you exited the insurance structure, the projections for cash value is 22.1 million, and the death benefit was almost 33 million. So for that $5.2 million of expense, you're getting, more than 6x return on the death benefit. And that's if you don't pull the lever and pay off, some of that loan with some of the liquidity after they sell the business.
Gotcha. Because in their business is extremely dynamic. Things could change. They could want to sell early. They could want to sell later. They could get another partner, all these different things.
Yep.
What you're saying is that structure, because of how the policy is built, gives them the options to pay less, pay more, increase, decrease death benefit, and just kind of suss out what needs to be sussed out in the future.
Yeah, exactly. Let's say in this example, say that they were focused on a $30 million estate tax liability. And that's how we kind of backed into what that death benefit at age 90 needed to be. Well, in 10 years, if they sell, well, maybe it's not 30 million. Maybe they need 50 million now because the value of their estate just skyrocketed on them. Well, if they use some of that liquidity to pay down the debt, that death benefit is not going to be 33 million. It's going to be 50 million because that's just a lever that they can pull.
Wow. So they don't have to come back to you in 5-6 years to buy another insurance policy. If you do this right the first time, you've got the flexibility to make that death benefit number move hypothetically where we need it to move.
You're absolutely right. And I think that's incredible. And it's an important thing as well. Just we think about servicing these things. So we've talked a lot about, oh my gosh, I hope they're keeping an eye on the ball whenever, they go into one of these structures. You got to go in eyes wide open. I think that's a differentiator for practices that we meet year in, year out, biannually, annually at minimum, about where the policy is and is it still meeting the goals of the family? And if not, what do we need to adjust?
Amazing.
One thing I just wanted to touch on a little bit because I feel like it's come up a lot. I keep saying SOFR over and over again. It's almost like, it sounds like sofa. I don't know what you're talking about. But it's SOFR, and it's an acronym that stands for the Secured Overnight Financing Rate. And on its face, what it really means is like, this is how much banks are borrowing from each other. It's the rate it's like the base rate that they have. Okay. So whenever you're looking at premium financing transactions, your base rate in your term sheet is usually going to be SOFR plus, or it's going to be the prime rate minus. And those are the two general rates. Those are two benchmarks. Yeah. But the interesting thing I think that's fun about the SOFR forward curve, because we've also mentioned that, is that, SOFR is an overnight rate, which means it changes
every single day.
Every single day it changes, right? Which means your loan rate changes
every day,
every single day. And so there's this idea of what is a SOFR forward curve. And what that really means is like, what is a Fed's expectation or what do they want SOFR to be?
Analysis of where we're going to be tomorrow.
And, between now and 10 years, yeah, exactly. What do we expect it to be? So one of the amusing things that I've seen with SOFR is that, well, nobody knows what it actually is going to be ever. Day to day, sure. But, if something happens in the market, well, they can fluctuate very quickly because the Fed sometimes will act abruptly. Other times it will be, nope, slow and steady. You just don't know. So there's this idea of a SOFR Harry chart is what it's called out there. And it's a fun chart. It's basically at any point in time, you look at the forward curve at that moment and you draw it out. And if you do that, it looks like hair coming off the actual curve because it's just wildly inaccurate. Yeah, it's all over the place.
So what you're saying is the SOFR rate, because it adjusts every night, we can set that on a graph because we know what always happened historically, right? It's going all over the place.
Yeah.
But what you're talking about here and what's showing us on the screen is brightest minds in the industry at each one of these points are then predicting what the next 10 years are going to look like.
Yep.
And these predictions, as you can see, basically are unhelpful. They're all over the place.
So the point is, again, if you're going into financing, just understand that rate is going to change.
Yeah.
And it could be way up or it could be zero, like what we saw not too long ago. You just don't know. You just got to be prepared to weather that.
Yeah. And this goes back and reinforces one of the statements that we've made a couple of times is if you're going to buy an insurance policy, you also need to be able to pay for that insurance policy regardless of the banking situation that you find yourself in.
That's right.
Yeah.
You got it.
Commitments are important.
Awesome.
So SOFR curve, area chart, super, super fun. I would imagine there's something similar to prime rate predictions.
Well, prime rate's prime rate.
And it just gets us every
There you go.
day.
Yeah.
So, okay. And it's prime minus, and this is SOFR plus.
That's right. Yeah. Usually it's a prime minus, and then they usually kind of align.
So we're going to dive into the 5 key team members that you need to have in any premium finance situation. Each one of these team members is important. They play in their own lane, but they also collaborate together as a team to make sure that your overall insurance portfolio stays healthy for a very long time. So we've got the insurance advisor.
Yep.
We've got a wealth advisor, which may be looking at assets within the family, doing other management for their assets, right?
Mm-hmm.
We've got an attorney who understands the broader picture of the estate plan itself, a CPA who's maybe in a little bit more in the details on the tax side. And then we also have the bank and that lender relationship. Now, to your point, you as the quarterback in this example may bring in some of those relationships or leverage the existing relationships.
Yeah.
But that's the summary of the core team.
No, that's right. And the important thing is to get everybody together, speaking the same language, row in the same direction. Yeah, you'll get there. Row in the same direction. It's a collaborative effort to get these done correctly initially, and then to keep them going for a very, very long time.
We're going to walk through in this next couple of minutes here, talking about the key team members that really need to be a part of any premium finance transaction from one end to the other end. Let's start off by, of course, we need an insurance professional, right? Mm-hmm. What qualifications would that insurance professional need to have? Is it like, oh, they need a degree in premium finance, or is it just they need to know what the heck they're doing?
Yeah, I wish that there was a degree in premium financing. Sometimes I wish there was a degree in life insurance, to be honest. I mean, there's certainly some designations out there, and I think that, working with professionals that maybe have some of those designations might be a good, like a barrier at least, like a bare minimum. But you certainly want somebody who is independent, meaning they're not beholden to one singular insurance company. You want them to be able to offer you solutions that run the gamut of the solutions out there. So I think that's important. I think another thing is that they've got like real experience in premium financing that they can back up, right? It's one thing to say, yes, I've done premium financing, and maybe through a friend, they helped do something. It's much different working with somebody who has serviced and done a lot of premium financing for a number of years. Their perspective is going to be significantly different than somebody who has
just started,
and hasn't done that. That's right.
And so I know we're going to be talking about additional team members. Mm-hmm. In this analogy, who typically is the quarterback behind everything? Yeah,
in my experience, there's usually 2 people that end up being the quarterback. One is the insurance agent themselves, because if they know what they're doing in the financing space, they know how to coordinate the capital, the bank, they know how to coordinate the insurance company. We talked about underwriting, I think in one of the previous segments. Underwriting is an art, and it's really, really important to get right. Yeah. So the insurance advisor plays a critical role there. And then premium financing, well, you have lenders and you have banks. And so if that person really understands that dynamic, that's a good person to be quarterbacking it. The other person that I think is really important is the attorney as well. So a lot of times they're pointing to helping, reasons why the insurance makes sense. So again, you don't need insurance, and this isn't a thing for you. But if you do need insurance and your attorney is telling you need insurance, and they understand premium financing, how it fits into the broader spectrum of what you're trying to accomplish in your estate plan, then sometimes the attorney can also be the quarterback. My position is I'm a big time collaborator. So I just love getting everybody in the same boat and rowing the same direction on behalf of the client, because that's where, honestly, that's where everybody wins. As you need, again, from a focal point, usually it's going to be the insurance advisor or the attorney.
So positioning now the attorney as another key person, have you found yourself in situations where a client needs insurance, they come to you and they don't have an attorney, or is it most often that they do already have somebody?
Yeah, it's both. We see both. So, we find ourselves working with a lot of the attorneys for the family. Again, the attorney's going to have, in that instance, is going to have a lot of background information about the need for insurance. They're going to know everything there is to know about the estate plan and what's been done and what hasn't been done and what needs to be done and is going to be done. Because it's not all just about insurance. It could be, making sales on IDIT, or maybe it's gifting to trust or whatever it is, right? But they're going to have context around what else is going on with the family and how insurance fits in. So yeah, when they have that attorney, makes my life a little bit easier. Now, when they don't have an attorney, what we do, like we'll actually put a pause on things. Like, okay, look, I agree you need life insurance for X, Y, and Z reasons. That's why you came. This is the problem we're trying to solve, but we need an attorney in here as well, right? You need their voice on your side to make sure that the insurance fits into all of the other planning tools that you could deploy to help solve the problem that you're doing. Because life insurance isn't the solution to everything. It's a piece of the solution.
It's a piece of the larger puzzle.
Yeah.
And then, there's something one of my mentors used to say all the time is that we never want to over obligate your future dollars to a life insurance strategy when we don't know the broader picture of what all the other things your dollars are doing.
That's a great quote.
And I think in this instance, it's higher stakes. Like we're not messing up somebody's budget. We're messing up their entire lineage and legacy. Right.
Right.
So getting it right the first time, working with the broader picture and then backing into a solution, I think is really powerful.
That's right. Totally agree. And this is where accountants come into play as well. So accountants also can be that point person too. Again, they have a lot of knowledge about what's going on with the family, the inner workings of the family. Maybe they're not drafting the trust and everything, but they're doing the tax returns for it and they're doing the personal tax returns. They know where all the cash flows are at and maybe what's possible and not possible with that balance sheet too. And so that the accountant becomes just as important as the attorney and the insurance advisor in making sure that, again, the pieces make sense and work. There's also some things, I think we're going to talk about it a little bit later about, gift tax and, like how you actually do these types of things with large premiums.
Right.
And again, the accountant plays a huge role in that because they're the ones that are filing the tax returns. They have to be there.
Yeah, absolutely. So the advisor, the insurance advisor specifically, an attorney that really helps build in the broader picture, is a CPA that helps identify effectively dollars, liquidity, places to take these dollars from. And then of course that fourth one here on that stool is going to be the bank. Right, it's a lender relationship. Yeah,
there's the lender relationship as well, right? Banks, I mean, they're providing the capital, so clearly they have an important seat.
They have an
important seat at the table. They're going to have an opinion. Again, they're going to want to help right size the situation to make sure that from a balance sheet perspective that it makes sense,
right?
And that they could support that kind of debt, right? So they're almost like a checks and balances because if they don't feel that you're credit worthy enough to do it, they're going to say no. Fortunately, when we work with institutions, we've kind of already crossed that road by the time we get there. But no, they played a very important role. They're a partner in this for the long term. You're going to be speaking with that bank for quite some time. Yeah, I think the other, just to add one more on there, that's important to have a seat at the table is the wealth advisor as well. So just like the accountant and the attorney, they are going to have a lot of inside knowledge about the inner workings of the family, how they like to deploy their capital, how much they spend on an annual basis, what they're willing to invest in. Are they risk averse? Are they risk takers, right? All those things that kind of dictate or help dictate at least whether financing might make sense for somebody. Right. So having that individual at the table and again, part of that collaborative team is really important too.
Yeah. And having that overarching collaborative approach can also help you as an advisor know which product to position, which carrier, which underlying assets, if it's an IUL to invest into. That's right. All these different things. It seems to be that this is a very complicated picture, but if you do it right, it creates a very, very nice synergy. It
does. And sometimes it can be like this, going through this process can help glue everything together and really put the puzzle pieces together for a family, right? When you have all of those seemingly disparate opinions and thoughts coming together, and again, working in a cohesive manner for a singular goal of helping the client out, both for the short term and the long term. Honestly, that's where everybody wins.
Rowing in the same direction is kind of important.
There you go.
So would you say that a big red flag then would be if you're talking to an advisor or being approached by an advisor who basically says like, look, we can do it all in-house. We have all the expertise that's needed. Just come to us and we'll solve this. Would that be a bit of a red flag?
Yeah, a little bit. I don't know any insurance advisors that practice law. Or an insurance advisor that does accounting.
Yeah.
And you need all those people at the table, right? It's okay to have, a group that has a lot of expertise in planning, a lot of expertise in insurance. Our firm certainly does. But you need those other people to help execute those things. If somebody says they're doing it all in-house and not asking, hey, who else is sitting around your table that I should know? That's kind of a red flag.
Gotcha. when it comes to exiting the premium finance relationship with the bank, there seems to be a couple of different things we've flirted around, we've talked about, but I think something that's helpful is if you don't know where you're going, you're not ever going to get there, right? If you put your ladder against the wrong building, you find yourself at the top of that ladder, all of a sudden you look over, wait a minute, that's the building I was supposed to be on. So we always have to start with the end in mind. So would you lay the groundwork for this conversation about why it's so important to start with that exit when you're starting to think about premium financing?
Yeah, it's really important to start with the end in mind, because if you don't know what that ultimate outcome needs to be and you're not setting the proper expectations on how you're going to get there, then that probably doesn't mean you have great conversations year in, year out about how you're actually going to get where you thought you were going to go.
Yeah.
Right?
So how do you track progress?
I feel like it's like an Alice in Wonderland. I don't know where we're going. So no, you have to have that. You have to have that plan in mind. Like any kind of planning has to have some kind of a goal built on it, right? Premium financing has a goal of providing liquidity and death benefit for a family, but premium financing in and of itself has a goal of hopefully someday exiting that bank loan. You have to have that picture in mind as you're going into it. You need to know if, yes, I plan on using all the cash value inside the policy as my exit strategy. That's the only exit strategy I've got. It's the only one I'm going to entertain. Okay, great. We just need to have that in mind, right? That needs to be part of the goal. Know how fast that cash value can build up, where it's at every year, and when can we maybe use that to use as an exit. Or maybe it's, nope, I'm going to sell my business in 10 years and I'm just going to use liquidity from that. I'm going to pay this off. I'm going to wipe this bank out. I'm going to have a nice big insurance policy over here that I don't have to think about too much anymore. That's great. That's what I'm going to do. Or maybe it's something in between. Maybe it's
blend of the two.
Some blend of the two. Yeah. Maybe I'm going to get a liquidity event and I'll pay some of it down, but I still want to use cash value to exit part of it. And I think that, it's okay for like the ultimate goal of the death benefit to change over time. I've discussed a bit about, paying some of the bank loan down with outside capital to push up the death benefit long term because maybe they need more death benefit. Or maybe some people are capitalizing interest because they're deploying capital over here. Those are all fine, but you still have to make sure that whatever you're doing in that interim time still fits with your long-term goal and what you're trying to accomplish. So if you're going to capitalize interest, you need to know what it's going to mean when you try to exit via cash value, if that's your only medium to do so.
Of course, we're making some assumptions on the growth of your assets from the policy, all these different things. And so planning doesn't happen in a vacuum, but it also doesn't stay in a vacuum.
No,
so it's this constantly moving target. How often would you say that you choose to meet with your clients who have existing finance portfolios that you set them up with to touch base and make sure the strategy is still working?
Yeah, we like to at least touch base twice a year. So one, just a general checkup. Hi, how's it going? Has anything changed? And then we have a big annual review as well, where we go through the actual performance policies. As you know, life insurance is generally a year to year kind of look, right? You start here and, you're either getting a dividend in a year or you're getting a credit for your IUL in a year. So what's happening in between, maybe less important on the numbers, unless you know something is coming up, like you're worried about a collateral call, maybe in the middle of it, you're like, I think this is going to be a 0 year. So we probably need to think about moving some additional collateral over. That in between meeting can be important for those types of things. Outside of that, you're looking at least once a year to check and just make sure everything is running as smoothly as it's supposed to. And that again, the goal is still the same.
Got it. And if the goal has changed, exercise some flexibility that was already built into the plan from the beginning.
Got it. That's right. We need more death benefit. We need less of that. More cash. I need less cash, whatever it is. That's right.
Yeah. Yep. So what would you say is the biggest red flag you see from advisors pitching this idea to, effectively the people you've also talked to, the prospects that you end up working with?
Yeah, I think it's not being transparent about all of the moving parts inside the structure. Not to belabor all of those again, but there's a lot of them. But I think that also not really talking about how the collateral can fluctuate year over year and how you need to have that high point collateral in mind, even under, say, stress scenarios. So just, I see a lot where they're really painting a rosy picture around the collateral requirement. And then years 2, 3, 4, clients are going, wait, I don't, what do you mean I have to post additional
collateral? Well, the policy didn't perform, or now you have to put more premium in if you don't want to secure your collateral.
That's right.
Yeah. I'm sure it's a hard conversation.
Yeah. I mean, yeah, it can be. When you're coming in, looking at somebody else's work, it's usually not fun, but I've good bedside manners. We do the best we can. I would rather point it out and it be, not a fun conversation. If I'm, again, working with an outside person. not a fun conversation at the moment, so we can have a path to fixing it on a go-forward basis. And if it's a client that I help put it in place, obviously we're having these conversations year round. We can keep things on track.
Amazing. Well, I think we've talked around the whole idea of needing an exit plan very well. Was there anything else you would add on the back end here to solidify that?
Yeah, again, it just needs to be part of the broader plan. And, you made the point before, like sometimes plans can change and sometimes goals can change, but that open and honest dialogue between you, your insurance advisor, your attorney, your CPA is going to be important for them to help guide you through better decisions on this and other things as well. So those check-ins they're just extremely important.
So diving into the more advanced planning side of things, what does that even mean? Whenever we're approaching an insurance situation, the insurance is one aspect of the plan. Like we were talking about earlier, Kris, it's almost like we have many, many different puzzle pieces that all have to fit together and play nicely in order for the insurance to work the way it's supposed to. And so I'd really like to dive deeper into what other pieces of the puzzle have we not talked about? How do those pieces work? And in what situations does insurance make or break an estate plan?
Yeah, for sure. Well, gosh, I hope it doesn't break an estate plan. Sounds like a total disaster.
The wrong way.
Yeah, I don't know what happened in that scenario. But anyway, so you're right. Life insurance has to fit into the greater context of what somebody's trying to do with their estate plan. So one of the things that we had mentioned early on, and maybe we kind of glossed over a little bit, is the ownership of the insurance policy itself. Yeah. So the heavy majority of insurance policies that we help place for folks if they're buy-sells or their estate tax planning or whatever it is going to be inside an irrevocable trust.
Yeah.
And the reason we set it up that way is so that death benefit stays outside of their estate for estate tax purposes, meaning if it's in that trust, it is not getting taxed 40% because it's inside of your estate. Right. It becomes hugely important because once that death benefit hits that trust, and now the trust has a death benefit, it can now use those funds to basically buy assets from the estate to give the estate liquidity to go and pay the estate tax. You kind of went all the way around. All of a sudden you have assets that are stepped up in basis. You just bought those out. Now they're in trust. The state has liquidity. They can go and pay those estate taxes as they need to. So the trust becomes really important for that.
So it seems within this type of insurance planning, all the conversations we've had so far, most of the clients we're going to be talking to are either going to be in estate tax territory already or projected to end up in estate tax territory by the time they pass.
Yeah.
So that threshold at the moment is if your estate is worth, I believe it's about $14 million as an individual. Married couple is about $28 million.
Yeah.
And if you're above that threshold, your net worth above that is taxed at 40% currently.
That's correct.
Now, we find ourselves in an interesting time in U.S. tax law in that there's a sunset that's still coming. We have a new president. We have new objectives, let's say, for a new tax proposal, but it hasn't happened yet. So at the moment, the end of 2025, beginning 2026, that exemption amount is going to be cut in half unless Congress does something.
That's right.
So perhaps we'll say that elephant in the room we don't have an answer to, but the high likelihood is that this will be extended. Do you think you'd agree with that? The estate tax exemption will stay where it is and continue to increase with inflation?
Honestly, the answer is I don't know.
Yeah. Right.
The problem is that if you look over time, the estate tax, both the exemption and the rate has really changed a lot over the years. And to your very point, right now we're about 14 million per individual, 28 for a couple. If it sunsets, it's going to be half of that. If they extend it, well, maybe it's going to be a little bit more than 14 million per person, a little more than 28 million, 29 million next year, or maybe they do something completely different. I don't know. I don't know what they're going to do.
Yeah.
The other thing to really consider when you're thinking about estate taxes, again, how it's changed over the years. We're talking about this in a vacuum. Like this is what's happening in this moment.
Yeah.
We really don't know what's going to happen in 4 years or 8 years or 12 years or 20. And how long does a life insurance policy go for some of these folks? What do you think?
40, 50 years.
Who knows?
Yeah.
So I think the important thing to take away for this is that, doing this type of planning, working with trusts, using life insurance just builds an incredible amount of flexibility for your planning. As those things change, as your family needs change, this can become a real catalyst for like future generational wealth and success for the family.
And you kind of touch on a very excellent point, in my opinion, because to your point, we don't know where things are going to be. No. And the other wild card is you don't know when you're going to die. Nope. And it's the laws at the time of your death in that year, what the tax law is, that really matters.
Yeah.
And so because nobody has a crystal ball, what's the benefit of doing planning at all? One could argue that, well, if we don't know what's going to be in the future, why try to mitigate that risk?
Fair point. But if you don't plan, then you might be setting yourself up for a worst case scenario.
Mm-hmm.
Maybe they pull it down to a $1 million exemption.
Gosh.
I don't know.
Yeah. It's
Could
a
be a
very good
problem.
point.
I think the flip side of that would be, well, when Steinbrenner passed away, there was no estate tax. Sure. But at that point, there was no estate tax, but they also didn't get a step up in basis. That creates a different liquidity need issue as well. So there's always something. So again, planning, life insurance, when done correctly, just builds a ton of long-term flexibility.
Yeah. So no matter what tax or legislative environment you find yourself in, you've already developed the framework.
That's right.
To be able to weather any storm.
You got it. That's exactly right.
Okay. Well, there's definitely a lot of different advanced planning structures and possibilities on the table in today's environment. What are some very common ones that you have seen play very nicely with premium financing?
For sure. So I think the most, probably the most common ones is the use of what they call split dollar transactions paired with a premium finance transaction. So in our industry, in the legal world, we have a terrible way of naming everything. We overcomplicate stuff. You've got a GRAT with a grantor retained annuity trust. Okay, what does that mean? One of my favorites is an IDGIT, they call it an intentionally defective grantor trust. I want to get something that's intentionally defective. Yes, you do. Yeah, sure. And then we have split dollar. What?
What does that mean?
Going to take a dollar bill and cut it in half? And the answer is, well, kind of.
Yeah.
So a split dollar is really just a fancy way of saying, if I find me and you're my trust, I'm just going to lend money to you. So I'm going to take money out of my pocket. I'm going to lend it.
And then I would take those dollars and pay for the life insurance policy.
In that case, you would go and pay for the life insurance policy, right? So they call that a split dollar transaction. And so the benefit that you're getting, again, we were talking about a bank, right? So a bank is going to loan money to pay for the insurance premium. Well, what you could do is have...
So I just said, and then the trust pays the premium on life insurance policy.
Right. And the trust pays the insurance premium on the life insurance policy. So if you think about that from a gift tax perspective, right? If I loan you money, there's an interest that's due there, right? You owe me interest.
It's a loan.
But guess what? You have a life insurance policy. You're not going to pay me interest because you don't have the capital to do that, right? So what ends up happening is I'm going to forgive that, and I'm going to forgive it via a gift. It's going to be an annual gift, or maybe if it's larger than what the annual exemption is, then it's going to get into your lifetime. You have to file a 709.
And just to clarify, the 709 exemption is up to the estate tax limit, the $14 million per person we talked about.
That's right. That's right. And so when you use that, it just lowers that amount over time. And so the advantage of doing it this way, though, is that, again, that's the gift. So you're not having to gift an entire $1 million. You're gifting a very small portion of that to get that death benefit inside of the trust because it's just the interest amount that you're gifting, right? So that's an approach of your typical loan regime, split dollar is what they call it. And in that scenario, the interest that's due is based on what they call the applicable federal rate, so the AFR rates. So between 1 and 3 years, you have a low rate. Between 3 and 9 years, you have what they call midterm rate, and then you have the long-term rate for any notes that are over 9 years.
Yeah,
but that kind of dictates what that gift amount is going to be every single.
And so in this example, you're lending money to me. Yeah. I'm the trust in this example. Lending money to the trust. Yeah. Let's say it's $1 million loan, but the gift is only based on the interest payment that is assumed but not required. So said another way, 5% interest, so $50,000 in this $1 million loan example, you'd be gifting $50,000.
That's right. That's exactly right. Yep. And again, it just helps make sure that as much as possible of that death benefit stays inside the trust because it's another important aspect about just a dollar generally is that we do have a loan between each other. So if I loan you $1 million, and then that death benefit is paid out, you still owe me $1 million. So that's going to go back into my estate. So we want to minimize that as much as we possibly can. If we want to keep everything outside of the estate as much as possible. Right?
Gotcha. So let's do this insurance policy over here on this side of the table. $1 million a year. It's going to buy life expectancy after 10 years of payments, maybe $35 million.
Sure.
Cool. So life expectancy, $35 million is paid into this trust. This trust now has to pay your estate $10 million.
Yeah.
Because the interest had been forgiven, so that wasn't compounding. But that premium that you paid into the trust, that trust and life insurance policy, does have to be repaid.
That's right.
So in this example, we've captured $25 million of growth outside of the estate to help pay for estate taxes, but $10 million is coming back into your estate.
Right. Yep. Exactly.
Okay.
Yep. You got it. Now there is another fun form of split dollar called economic benefit split dollar. So we just talked about a more traditional way of thinking about loans, right? I'm going to loan money to you. You're going to owe me interest rate. I'm going to gift it over, right? Everything's kosher. With economic benefit split dollar, the amount of the gift is not necessarily based on a prevailing interest rate. It's based on the cost of a 1-year term policy. Yeah, I mean, look, at the end of the day, what we see most of our clients doing whenever they get a life insurance policy, whether it's financed or not, if it's a larger one for a particular purpose, like estate taxes, we'll just pick on that one for a little while. Sure. Generally, it's going to be inside an irrevocable life insurance trust that ensures that death benefit is kept outside of the estate for estate tax purposes, meaning anything trapped inside this trust won't be subject to the 40% estate tax that things inside of the estate are going to hit. So mechanically, how this works is that when the death benefit is paid out to the trust is going to have all the cash, right? Estate has assets, estate owes the IRS. The trust is going to go and either loan or buy assets from the estate, get those into the trust, and now the estate has liquidity to go and pay the IRS, right?
Got it. And now those assets are held in benefit for the beneficiaries of that trust.
Right, which is great because now typically those are going to be dynastic trusts, hopefully outside of anybody's future taxable estates for estate tax purposes for many, many generations. Right. That said, it doesn't just have to be the irrevocable life insurance trust. I think that the ILA is sort of the common thing out there. But at the end of the day, it's a GST trust. It's a dynasty trust. Usually those come in different forms. And they have little different purposes with them as well. So when we think about the broader use of planning and insurance, again, life insurance is a component of a broader plan. Right. A lot of these families are looking at trusts and going, well, can I sell assets to a trust? Sure. You can sell assets to a trust. And that just means all the appreciation of that asset is now outside of your estate. Can you gift assets to a trust? For sure. We define the lifetime exemption is about $14 million per person, right? 28 per couple. You can gift that to trust as well. Could a spouse be a beneficiary of trust? Sure. Called a spousal lifetime access trust. Yeah. There's possibilities. There's a lot of flexibility. There's a thing called when you sell assets to a trust, this is one of my favorite ones. It's called an intentionally defective grantor trust. Kind of a ridiculous name because nobody in our industry knows how to name anything well. Why would you buy something that's defective? Well, why not? You would. Because with an intentionally defective grantor trust, which could also own life insurance or other assets that you gifted and sold to it, you get to pay income taxes on behalf of the trust. Like, well, wait a minute. Well, why would I want to pay income taxes on my trust? What's the benefit of that? And the reason is if the trust has income taxes and you get to pay them, that means the trust gets to grow income tax free. You're paying income taxes, which means you're depleting the value of your estate,
increasing the value outside of your estate.
So you're reducing your estate tax liability on one side and increasing the value of the assets and the other. And so when you do all these little planning tools and you balance everything out and you fit the pieces of the puzzle together, life insurance comes in and fills that gap that maybe you weren't able to plan away.
Yeah. And this goes into something you said earlier in one of our very first videos that we shot together. Is you said that the estate plan, a lot of those pieces need to be fit together first so that insurance can come in and fit the gap.
That's right.
If you lead with insurance, oftentimes you don't know what you're solving for.
Yeah.
So lead with insurance, get this banging policy, really, really exciting, and then do all the extra planning, realize I have way too much insurance that I don't need. Or maybe the other ways, I don't have enough and I have to go through all that again.
That's right.
So having the plan kind of developed and then using life insurance to come alongside, to complement, to fill the gap, to enhance the plan seems to be the right direction. Is that fair?
Yeah, completely. And I think that, again, getting the team around it, right? Okay. No, you're absolutely right. The insurance has to fit into the broader plan and the broader planning has to fit into what the insurance can do for the plan. So it's important to get everybody around the table. Again, the accountant, the attorney, the wealth manager, and everybody, again, what is a problem? What are we trying to solve? And what are all the levers from a planning perspective
that we have the ability to pull?
That we can pull to get the client on the right direction, to give ourselves some flexibility down the road and get the life insurance on the onset. Like if all these things are sort of happening simultaneously, the pieces fit better to begin with, and it gives you more ways to manipulate down the road. And also just an interesting point to make is that whenever somebody's going through this process of doing the planning of life insurance is going to be a component of it. It's important to do it early, not just because how does it fit into the plan and how are we going to make the math work, But also you just never know what's going to happen with somebody's health. So
Yeah.
if you build your plan, you know insurance is going to be a component of it, but you wait 5 years to get the insurance. Well, a lot can happen to somebody's health in just 5 years. So
Yeah.
I think that when you're thinking about planning and you're looking at all the puzzle pieces, you're right. It all needs to be looked at kind of simultaneously.
Yeah, I know it's happened to me. I think it happened to a colleague of ours as well, Brian, who lost a client in the middle of the planning phase. Right.
Yeah.
So you never know what's going to happen. So starting it sooner is better, even if you don't implement, right? Because you get ahead of it. Because insurance qualification, especially for something as complex as premium finance, can take 6 to 9 months, maybe longer if it's a much larger policy.
Yeah.
And so not only on the health side, but just the complications side, bringing in a bank, connecting with the carriers, all these different pieces. So it's almost, it seems reasonable to me if insurance is something that is understood and the attorney and everybody else in the equation believes that it's going to be a good thing for this overall estate plan, get the ball rolling on getting qualified for insurance. Now, you haven't committed to anything. You haven't said, this is the amount of death benefit I'm buying, but you've started.
Right.
And so it's kind of interesting to start thinking about how all these pieces play together, because there are many, many pieces on the board, and working with somebody such as yourself and your firm to coordinate all of that seems to be like, how would you even try to do it without a team like that on your side?
Yeah, no, for real. Everybody's lives get very, very busy. Again, we're talking about people who are running businesses or they're running hedge funds, like their phone's ringing nonstop. And it's hard for them to sit down and focus on, okay, what is my plan? What does that look like?
Yeah.
Okay, what is my insurance? How does that fit? Why? If you've got, one or two people sitting at the table who are really helping navigate those aspects of it, doing the math, doing the testing, and again, working to get everybody rowing the same direction on behalf of the client and really advocating for them, then you can now present that to the client, like, this is where we think and why, and they'll agree or not agree, and you move and navigate from there. But to your point, you got to start early. I mean, I think the worst thing is that if you don't start, because what could happen if you don't start planning?
Well, I think at the end of the day, when it comes to you leaving money behind, there's really three options. You can leave money behind to people you care about.
Yep.
You can leave money behind to charities you care about.
Totally.
Or you can leave behind money to the IRS.
Everybody loves
and
that.
Everybody hates that. And so the goal, I think, with quality planning is, which one of these three do you want to disinherit? Right. If you can do that effectively, almost everybody's going to pick disinheriting the IRS.
Sure.
Right. And so we have the ability to maximize other areas. And this is where trust work can come into play. And, we're a couple minutes into this session, but for those who are watching who may not be clear on the different types of trust, generally fall into two camps, right? We've got a revocable trust and we've got irrevocable.
Yeah.
Basic distinction is revocable trust means you can change it while you're alive.
Sure.
If you create it, you can change it. Irrevocable generally means you can't change it.
Yeah.
And because of that separation of change, that then can be excluded from your taxable estate, the things that trust owns. So what we're talking about is this idea to take assets that you own in your personal estate, personal name, moving them in some capacity into an irrevocable structure outside of your taxable estate.
Yep.
What that does for us is it gives us all the appreciation and growth on those assets in an environment where we're not going to get hit with a 40% tax in the future.
That's right.
So the benefit of coupling life insurance into this equation is that you can't get rid of all tax in most cases. And so life insurance provides that liquidity. We can put that liquidity provision, the death benefit, outside of your estate so it doesn't make the estate tax issue worse.
Mm-hmm.
And it gets us into a very nice situation in the future where now, all right, the Pipers come, the Grim Reaper came, we're at a situation where now we need that liquidity.
Right.
There's a death benefit. We can move that back out to buy assets out of the estate, like you said, bring it back into that trust. Now the estate has liquidity to pay the IRS.
Yeah, no, that's right. It's just a ton of flexibility right now. You're not worried about what buildings are the heirs going to have to sell to pay the IRS.
Yeah.
What's going to happen to my business, my family business that I spent so much time building up, if I have to somehow liquidate 40% of it, if that's even possible
at that point.
Mainly be possible at that point to pay an estate tax. So planning plus insurance, that marriage right there really gives a lot of people a lot of flexibility, and they're planning a lot of other protections too that it's probably worth touching on. Like asset protection, trust can offer a lot of asset protection capabilities, and the trust can be flexible too. So, I know we talked about, they're irrevocable, can't really change them a whole lot, but you can set guardrails for your kids, right? So it doesn't have to be so rigid, or it can be very rigid. So you can have that sense of, after death control and what happens with those assets, after you pass away. And then some trusts will allow, maybe even your spouse could be a beneficiary of one. So, that could be an interesting way to do some planning, but still make sure that your spouse has access they need.
You too.
Right. And there's different ways you might use life insurance for all of those aspects and how it fits in. But again, getting the right team assembled, with the right people quarterbacking, as you said, can really bring a lot of really unique, and interesting ideas to help a family out.
Yeah. I think big picture wise, we could say pretty confidently that premium financing, as we've said before, is a tool. It's a tool. Right? It's not a gimmick. It's a tool. It's something that can be very beneficial. And the way we lay it out within an insurance plan, coupled with an estate plan, if you're not considering the tax implications of what you're doing, if you're not having a tax advisor on this, a tax attorney, a CPA, you're not playing with these key players, you're really playing with fire.
Yeah. No, you're right. Again, premium financing, planning, it is not a set it and forget it thing, right? You've got to look at it year in, year out. You've got to make sure that all the gift tax returns are being filed appropriately. If you're selling things to asset, you need to make sure they're bona fide loans. When there's a trust, you need to make sure that crummy notices are sent. So you have to work with attorneys and CPAs who can help facilitate all those things. And you've got to have that really strong insurance advisor that understands the banking side, the insurance side, and then all of those other moving parts, and making sure that it's working cohesively for a very, very long time.
Someone might be watching this, watch a lot of videos we came out with, and come all the way to the end and think, this is just so complicated. Why would I ever go down this road? So put a question back onto you.
Yeah.
This is, yes, very complicated, but the benefits of doing this type of planning often gives you much more liquidity, opportunity, and optionality long-term to make your entire estate plan more effective at doing what it's intended to do. Passing money on to the people you care about, the charities you care about, or the U.S. government. Once again, disinherit one of those three, please.
Yeah.
So, we find ourselves in an interesting planning dynamic when we start looking at premium financing, because insurance, you don't have to finance it at all. It brings in complexity, but it also gives you a lot of additional benefit in the future.
Yeah, 100%. I think that when you're looking at estate plans of that size, I don't know why somebody wouldn't want life insurance to create that liquidity, because it does solve a lot of problems. And then to your point, that additional complexity of using premium financing and being able to deploy your capital strategically over time, if that is wildly important to whatever scenario they're in, then absolutely premium financing can make a ton of sense.
Amazing.
Yep.
I think we could turn this section on advanced planning into a 3-day seminar. So we're not going to, but this gives you an idea of how beneficial having the entire plan, how all the different moving pieces, gifting, different trusts, different access, different levels of control, right?
100%.
Put you still in the driver's seat of your insurance plan, your estate plan, but it removes you enough to take out a lot of the future inheritance to the U.S. government, or future inheritance to people you don't want having money.
For multiple generations.
It's
a great way to
right. And this isn't tax evasion. This is literally part of the U.S. tax code.
That's it.